MSCI Asia Pacific up by 0.4%. So despite a trifecta of measures thrown at the Chinese economy overnight, we see gains in China, but not particularly outsized gains. The Korean market doing pretty well as well. Samsung getting a boost from some important research around its role with Nvidia. Natural gas prices in Europe are moving higher, but bear in mind we fell 11% on this benchmark yesterday. Strike action and the possibility of that still looms large in Australia. Brent prices, those have been on the move. You can see we've got an 87 handle. This as a result of OPEC Plus, Russia in particular, and the inventories in the US. 10-year bond yields in focus, moving in the opposite direction to yesterday. Tom, futures, what do they show?
Bit of a mixed picture. DAX futures pointing lower by about 0.1%. FTSE 100 futures, though, looking up to gains of about 16 points, maybe as a result of higher metal prices. Over in France, the CAC current pointing lower by about just 1.5 points. Anna.
Okay, so that's what the futures picture had suggested we'd see. So perhaps green on the FTSE 100, and we are seeing that at the start of the cash equity session. So the FTSE up by 0.2%, as you point out, Tom. Perhaps this to do with metals. We have seen commodities being moved higher in the Asia session, and it's broader than just oil. Oil is part of that, but it is broader, as Mark was telling us earlier. It's the metal story too. So up by 0.3%, in fact, on the FTSE 100. Interesting to see then what the sector breakdown tells us there. The Spanish IBEX up just 0.1%. The French market going a little bit lower. In terms of FX moves, no great moves here. During the Asia session, we had the Korean won doing pretty well as a result of, as I was mentioning, the Samsung moves. We also saw some export data that looked a bit rosier for the Korean economy, often looked at as an important global indicator. And these are the moves on the bond markets here in Europe, which are moving in the opposite direction to yesterday. Yesterday, we saw buying of bonds. The market focused on bringing those yields a little lower and focused on the idea that the ECB might pause. Today, we see something a little bit different, but we are, as you say, Tom, in a bit of a holding pattern, waiting for the non-farm payrolls and the other US data today.
So the basic resources sector is standing out today, along with energy. You talked about oil, you talked about gas, and of course that ties into the energy sector. Currently, as a sector, gaining 1.1% on the session. Yes, oil is higher. You're looking at that news coming through from Russia. They're going to extend those OPEC Plus cuts. We look for other members of OPEC Plus as well. Any commentary on that? And we know that the inventories have come in smaller than expected out of the US. So that's putting a floor under oil prices, at least for now, boosting energy as a sector. Basic resources also getting a lift, as we were discussing there, in terms of higher metals prices. That ties to the China story, those stimulus measures coming through, not necessarily supporting the equities market broadly, but certainly lifting some of the demand, lifting the prices from some of those basic resources that comes through and feeds into that economy. So that sector gaining 0.8%. On the downside, a little bit of softness for technology, just off 0.1%. Construction materials also down 0.4%. Food also off by 0.3. Treasure and leisure, though, gaining 0.2%. Banks lifted, for now at least, in the session, up 0.3%. It was interesting, it was real estate and financials that led in terms of the upside yesterday on what was otherwise a down day for European stocks. European stocks for the month of August added no gains at all. Today, the standouts, basic resources and energy. Anna.
Okay, so that's where we are across the sectors. Sophia Halter-Acosta joins us then from the Markets Today blog to talk us through some themes this morning. And we'll come to US data in just a moment, but let's start with China, because we have had, some of our colleagues calling it a trifecta of measures. There's been the moves around the FX market, but also some data and other measures in mortgages as well. So what stands out to you overnight from China then, Sophia?
Yes, exactly. So more stimulus, better than expected data, and the PBOC really pushing hard against yuan weakness. I think the PMI, and Tom will correct me on my pronunciation, but Caixin, it's the private survey that really shows us that manufacturing is picking up. This is not the part of the economy that Beijing cares most about. It is focusing on consumption and really trying to get that services sector part of the economy up. But it does suggest that perhaps stimulus is working. There is more demand. This is highly correlated to exports, so it might reflect more global demand. But again, we wanted positive news out of China, and this is positive news out of China. The pushing hard against yuan weakness, I still have questions over whether that will work or not, and the market has questions as well. One thing to note, though, it was quite interesting that all these measures, including also the housing market support measures, they were all announced before the open, which is very kind of rare for China. It tends to kind of announce things late on Friday. So this suggests that it wanted a supportive session today. Also, Singapore is closed for a holiday, and Hong Kong markets were closed for a typhoon. So thin liquidity, perhaps it was looking at bigger moves than it got, but a little bit, still some questions over whether any of these measures will work.
To your point, they clearly are concerned about the equity markets, aren't they, given the stamp duty cut that they've pushed through around trading as well. When it comes to the US, it's obviously all about non-farm payrolls today. We were speaking to Hugh Gimber of JP Morgan earlier this week. He said for him, the most important factor is going to be wage growth. That's where he's going to be focused. Where is your focus of attention going to be? How consequential is this non-farm payrolls data in terms of the guidance around the Fed?
Markets are really sensitive to any downside or upside surprises in US data right now. So I do think wage growth could be the one to watch. It's not just markets in the US. I mean, here, it really just moves the pound. Sam Unstead and I, we were talking on the Markets Today blog yesterday about how, you know, even if the pound is strengthening on some kind of news out of the UK, then the US data kind of just muddies the picture. So I just got a Goldman Sachs note, actually. They say that August payrolls actually tend to surprise on the downside. So they're calling for 149, a lot lower than consensus at 170. So let's watch out for that, whether bad news is good news for markets. But wage growth, I mean, that is the pressure for not just the Fed, but also obviously the BOE. And you know, we're expecting a, is it 0.2% increase in average hourly earnings? So, 0.3, that's the Goldman is expecting it a little bit softer than that. So again, is the US job market softening? Is it softening enough for the Fed to really pause in September? Or is the US job market still a bit too resilient for a pause?
So average earnings coming down from 0.4 to 0.3 is, as you say, the expectation. Is it too resilient? What's causing that resilience? Bloomberg Economics writing at length about Taylor Swift and her impact, and not just her, but also Oppenheimer and Barbie and all of the other sort of entertainment features of the US economy. I don't know how much of the last hour of the program you caught, Sophia, but if you missed it, then you missed Mark and Tom painfully trying to crowbar as many Taylor Swift song references.
I think we did it very smoothly and eloquently.
Do you think so?
Yeah,
Do you think
I'm convinced.
Okay, they're proud of themselves. More of that to come, no doubt. But there's a serious point here that Bloomberg Economics is making. Let's pivot to the UK economy, though, because here we've had some house price data out. Prices falling faster than had been anticipated.
Yes, exactly, and it really feeds into the kind of gloomier picture we've had on the UK housing market.
Well, this is like Groundhog Day. We get these headlines kind of on a weekly basis.
We do, Tom. But you know,
so what's different this time?
So I don't want to be a housing doomsayer, but we did get so prices are falling faster than expected. That was today's nationwide data. The number of mortgage approvals also fell for the first time in 3 months. And Zoopla says that home sales are expected to drop 20% this year to the lowest level since 2012. So are we finally seeing cracks in the housing market? I would say, though, that prices are still quite high. I mean, we're still far off the pre-pandemic levels. Yes. So there is still a lot of work to be done.
That's what Zoopla told us, wasn't it? Earlier this week, they were saying that if they fall 5%, this year, then that will still be 15% above pre-pandemic levels. So that just illustrates the big rise in house prices.
Just the rally, particularly in 2021,
yes,
right, during the
exactly.
pandemic. Sophia, you've totally failed at being and trying to avoid being a doom-monger on housing. I feel very depressed about the housing market now. Thank you, Sophia. Of course, the context around China data, as well as that look ahead to non-farm payrolls. Sophia Horta-Acosta from our Markets Today blog. Do check out what Sophia has to say, her commentary and analysis, along with the rest of the team, on the Bloomberg UK website, or by typing TLive Go on the terminal.
Let's get a check on the individual stocks on the move. Joe Easton has a briefing, and Joe, you were absolutely right about some of these movers. Give us an update.
So Arubis absolutely slammed in the opening moments of trading in Germany, down 16% now as the company announces that it may have been the victim of a theft after reviewing its recycling business. And we're seeing one of the largest shareholders, Salzgitter, falling 6%. also on the German market, the biggest movers on that exchange today for sure. In terms of the chip makers, bit of a mixed picture. We've got those two contrasting news. Firstly, Broadcom, bit of weakness in the US from that massive $300 billion chip maker. That fell after market, but Samsung gaining in Asia, and as I say, pretty mixed. ASM and Infineon only seeing small moves at the moment. In terms of some other stocks we are watching today, there was a big move when I moved away from my desk just now. SAS, the airline and logistics company over in Stockholm, soaring 22% following earnings. Profit better than expected, and they're saying that new investors are showing interest in that stock. I'll have to dig a bit deeper into that one. In terms of a decline in London, Direct Line, the insurance company, they've just announced that they have overcharged some of their insurance customers and will have to pay only around £30 million following negotiations with the Financial Conduct Authority, but investors not liking that. That one down around 2%. Then a sector I had my eye on yesterday is shipping. Kuhn and Nagel were speaking at a conference yesterday, and they warned that there is downside risk to pricing in the shipping sector, and it sent about 5 stocks lower just off those comments as they gave a presentation. That stock fell around 4% yesterday, coming down again. Maersk was hit yesterday too in Denmark, but we're seeing that decline paired today. I'll see if there's any fresh research on that one. In terms of the ratings changes we had in stocks to watch, and both of those stocks are falling. Volkswagen and Renault both downgraded at UBS, which goes sell on worries about the China impact in terms of competition. Companies like BYD and also Tesla cutting its prices, both those stocks among the biggest decliners. Repsol over in Spain, the energy company, they get a new overweight at Morgan Stanley, which actually goes overweight the entire energy sector in Europe today, saying that they expect buybacks and dividends to continue given the oil price remaining reasonably strong. And then finally, Beiersdorf, which is the owner of Nivea skin cream, they get an overweight at JP Morgan. Only a small rise there. They say that market will hold up better than the food industry. So JP Morgan overweight that one, up 0.5% today.
Thanks, Joe. From our equities team, Joe Easton, with all of the movers, some of which he called before the start of trade. So we appreciate that. Thanks to Joe for the update. Now, here are some of the things we're watching out for today. We're going to get a load of PMI data breaking this morning. Some of it falls in this hour. So in just 5 minutes, we start a run of sort of 4 announcements this hour. Then at 9:30 a.m., we get UK manufacturing PMI data. Then at 1:30 p.m., US non-farm payrolls and unemployment data for August. They all are released. A few hours later at 3 p.m., we'll also be watching the ISM manufacturing data, also out of the US. And finally, global central bank speakers, including Raphael Bostic, speak in a panel at the South African Reserve Board conference. And South Africa has loomed large in terms of monetary policy over the past 24 hours. I was watching yesterday those comments by Hugh Pill talking about a Table Mountain-shaped rates trajectory for the Bank of England, which got everybody thinking.
The Table Mountain. Well, it's quite good imagery, isn't it? I mean, and it was featured heavily on the front page of the FT as well, where they pointed to the fact, he said, we may not need additional hikes, but I want to see them, and I'm paraphrasing from Hugh Pill, higher for longer, and talked about that Table Mountain reference as a visual to kind of push out to 2024. That's where he wants to see rates higher for longer, pressuring the economy, but not so much necessarily that it breaks the back of it.
It's useful. And then an interesting data set up today in the United States, where we have the all-important, quote-unquote, non-farm payrolls, but then perhaps the equally as important ISM numbers on the US economy, and just what kind of cracks are we seeing in labour and continuing cracks or fissures in parts of the economy like manufacturing.
And you've seen that divergence in Europe, of course, between manufacturing and services, and then the concern that services, even that part of the economy in Europe, has started to soften. So that divergence, whether that's pronounced in the US as well, and what the linkages are as well between the US manufacturing sector and the kind of demand that you're seeing in China as that economy softens as well. So 2 important data points coming up in terms of the US and how we view that economy. Coming up, we're going to look ahead to, of course, that jobs data, what it could mean, of course, for the Fed in terms of expectations. Don't forget, markets still pressing in a less than 50% chance of another hike. Of course, the non-farm payrolls data could change that. That is a data point we watch and look ahead to. Stay with us for the details and the analysis. This is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside? This is Bloomberg. This is Markets Today. We are 15 minutes into our European trading session. You can see two-thirds of sectors roughly going negative today, but at the overall markets level, we're pretty flat across stocks here in Europe. You can see some divergence around that flat line. The London market getting some better gains from energy and basic resource stocks, so that's the story there. Let me just get to the breaking news around the Spanish economy. We've just had the numbers coming through in terms of the PMI manufacturing numbers for Spain, 46.5. Wow, that is weaker than expected. So the prior number, 47.8. It was expected that we'd actually tick slightly higher to 48.8 here, and we didn't. We've dropped down. But this is the first of a number of European manufacturing PMI stories that we're going to get details on today. Through this hour, in fact, we'll get Italy soon, then France, then Germany, all coming in quite quick succession towards the end of this hour. So we'll keep an eye on that. And some of them are expected to be really weak. 30 is the 3 is the handle on the German number, has been. And so we'll look for something similar to that. Let's get to Paul Flood, fund manager at Newton Investment Management. And Paul, let me start on the Eurozone economy then, because this data point from Spain sets that up. A little bit disappointing in terms of the manufacturing. I suppose the question here is, are people's poor expectations, weak expectations for manufacturing in Eurozone, are they all in the price already? Can we really trade any lower on the Eurozone growth story around these data points?
I think a lot is already in the price if you look at valuations of European stocks versus their US peers. But it is a story about rising interest rates, and we're now starting to feel the pain of those rising interest rates come through the delayed effect. And so I think we're starting to see some of that weakness come through in these numbers. But I don't think, if we continue to see numbers come in weaker than expected, that's going to help and support these share prices.
Paul, what's your view more broadly on these equity markets then? The downside of about 2% for the Nasdaq for the month of August, a little over 1.5% for the S&P, European stocks not adding any gains during the month of August. Are we at the start of a more significant, more pronounced downturn as these rates start to have this impact?
Well, I think clearly the central banks have been very clear that they're trying to bring inflation under control, and to do that, they want to bring demand down, and they also want to get unemployment and wage growth back in line with where they need to be. And so they'll continue to do this at a pace that will ensure that we see weakness in the economy to get that inflation number down. So it's no surprise that we're starting to see these weaker data points. I think it is much more challenging this cycle than it has been in previous cycles, particularly in the United States, where we're seeing a lot of consumers lock in very low mortgage rates for 30 years. So rising interest rates doesn't really affect the cash flow of the US consumer like it does in the UK and some of the European spaces, where we see refinancing of mortgages start to bite into consumer cash flows. So I think it may be a little bit harder but also it may take a longer period of time, given we've seen people, particularly in the UK, move from 2-year and variable rate mortgages to 5-year fixed rate mortgages. And then you've also got the baby boomers who are going into retirement. They don't have mortgages, so raising interest rates doesn't really affect their demand. In fact, you're increasing their disposable income by raising interest rates.
Okay, and let me, you mentioned in your notes the rebirth of the 60-40 portfolio, and given what you've said there about inflation coming down or central banks taking it seriously, how low does inflation have to get, Paul, do you think, for that 60-40 portfolio to still be front and centre, or to come back front and centre and make sense? Because obviously inflation can be the enemy of bonds as a diversifier. So how low does inflation have to be for this to make sense?
Well, I think that argument of bonds not working as a diversifier was last year's story. And I don't think investors give enough credit to the bond market on a forward-looking basis. So, 4 or 5% interest rates looks fairly attractive relative to Fed policy of 2%. And I think they'll be fairly successful, at least in the short term, getting inflation back down there. I think it'll be much more challenging on the longer term. But for the here and now, I think bonds will offer better diversification. They're offering the most attractive rates of return that we've had in over a decade. So I think it makes a lot more sense to have more bonds in your portfolio this year than you did last year. And so that's what we've been doing in our portfolios, is increasing our bond exposure, particularly at the shorter end of the yield curve. We're still a little bit worried that the higher for longer isn't being priced in by the market. And that could lead to rates at the longer end rising if we don't go towards some form of a recession here.
Paul, before we let you go, you're rebuilding positions in real assets and infrastructure. Explain that in this high rates environment. And if you have time, tie in your view on music royalties as well, as we hear obsess about the Taylor Swift effect on the US economy.
Yeah, I mean, well, start off with that. We've been big believers in music royalties. We really think the music industry has changed with the advent of music streaming. There's a lot of pricing power, and it's moved on from a discretionary purchase to something that's more like a utility purchase now. As we saw going through the pandemic, people didn't cut their music streaming subscriptions. In fact, they grew during the pandemic, and we're just seeing some of the performance royalties come back through into the revenue streams of the industry. And you've seen that in Universal Music. We're seeing that hopefully in Hypnosis Songs Fund, which is trading on a significant discount to net asset value. So that's an area we think will be much more resilient in a downturn, much like what consumer staples are, where we've been adding to exposure there through Reckitt Benckiser as well. So we think that's a good area to invest in. We've been adding to bonds quite materially, where we've taken weights from pretty much zero at the lower end to 12% up to about 30-35% today. So getting back towards that 60-40 level. And at the other side of that, as people have been concerned that inflation is coming down, assets have had quite a difficult time. So we think it would make sense to get a little bit more inflation protection coming into the portfolio to diversify more robust.
Paul Flood, thank you for joining us this Friday morning on the call around positioning around the front end of the curve and maybe a bit of opportunity in music royalties and real estate as well, some of those real assets at least. Thank you, Paul Flood, fund manager at Newlon Investment Management. Coming up, Europe's top copper producer plunges after warning of huge losses as a result of suspected theft. We get the details. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, The product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla. But Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customers like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back. This is Markets Today. We are 25 minutes into your European trading day, and markets are pretty flat, waiting for the non-farm payrolls and ISM data out of the US a little bit later. So a good time to diverge perhaps a little from the day-to-day moves in markets and go to Tom for his morning must-read. Tom.
Well, I'm not going to diverge that much, Anna, because it is about the non-farm payrolls. It's a preview from Anna Wong, our chief US economist, and the team. Now, their forecast is for slightly above the median estimate. The median is about 170,000. That is the expectation. Anna Wong and team think it's going to come in closer to about 182,000. But importantly, they say they are seeing now softness and cracks starting to appear in the labour market. And they also think that the number that's going to come out today is going to be flattered by Swiftonomics. Yes, Taylor Swift and her Eras tour across the US has driven huge demand for leisure and hospitality, and that's going to flatter the jobs picture. That disappears later in the year, Anna Wong says, and it's going to become more problematic for this labour market. Maybe good news for the Fed. Here's the standout quote then, the pull-out quote. Cracks in the labour market will widen in the coming months, and she puts ahead and points to a potential strike as well by the United Auto Workers, huge union, of course, and a possible government shutdown turning payrolls negative in the fall. A couple of other factors to bear in mind as well as we look at the chart as well that we have here in terms of labour participation, but also cutting hours. This is the hours, weekly hours cutting by employers. That is a pressure point as well. Participation rate is back up to pre-pandemic levels. There's plenty more coming up. We're going to talk China and these non-farm payrolls. This is Bloomberg.
That go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset? monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Markets Today. We're 30 minutes into the European trading day. Here are your top stories. Beijing trims banks' foreign currency reserve requirements in a bid to lift the yuan. Meanwhile, sentiment gets a boost as a Chinese manufacturing gauge unexpectedly shows growth. European stocks and US futures struggle for direction as markets expect cool American job growth, potentially easing inflation pressures. Plus, scandal in the skies. European aviation regulators have found an obscure UK company provided fake engine parts to repair engines on Airbus and Boeing planes. Lots to discuss then in terms of the individual stocks. Commodities very much in focus. We'll get to that conversation very shortly, Tom. But overall, we are waiting for more direction from US data later on today.
Across the benchmark here in Europe, as a result of that, it's a yawn fest. But you lift the lid and it's more interesting. There are some interesting stories to tell in the equity markets this morning, this Friday, of course, the first day of September. Across the benchmark then, you're flat here in Europe. The DAX down 9 points, just down about 0.1%. And the auto sector, and we'll unpack this shortly, is interesting when it comes to Germany and index there. The FTSE 100, 7,459, just gaining about 20 points. A bit of a lift there coming through from basic resources, gaining 0.3%. Let's have a look at the sectors then, because this for me is where this equity market becomes a little bit more interesting this Friday morning, particularly when you look at energy, when you look at commodities, and when you look at autos. So let's start on autos there, because look at that drop for that sector, 1.5%. You tie that to the news around Tesla cutting the prices of its Model S Plaid, or is it the Model 3 Plaid? It's one of the Plaids, or is it Plaid, over in China, by close to 20%. I'm convinced it's Plaid. Anyway, cuts again by Tesla to prices, and that, of course, is leading concern about competition. As a reminder, the price cuts coming through from the world's largest auto market, and the competition, of course, for those German automakers that, of course, have so much exposure to that market. So that's the auto sector. Big losses there, 1.5% for the session this Friday. We want to talk about energy as well. Will Kennedy is going to break down the details for us, so I'll briefly linger on this, but gains of close to 2%. OPEC Plus coming through, at least Russia saying they're going to extend those cuts around OPEC Plus. So Brent is at around $87 a barrel. The last time I checked, gas is also slightly higher in the session as well. And then you get the likes of copper lifting the basic resources sector up 0.4%. So as I said, top line across this benchmark, not much interesting, but it's when you get into the details that the stories come through, Anna. And of course, the non-farm payrolls is going to be really consequential for these markets later today.
Okay, let's get into some of those commodity stories. Europe's top copper producer, Rubis, is plunging after warning it may face huge losses as a result of a suspected theft. The company no longer expects to meet its profit forecast for the year. Another scandal in the metal sector. Let's get to Will Kennedy, our senior executive editor for energy and commodities. And we'll come, Will, good morning, to the broader energy space in a moment, and oil also very topical. But sticking with this Rubis story, this is a business that buys raw material from mines, but also buys a huge amount of copper-bearing scrap. And it seems that this is maybe where the area of concern is. Tell us a bit more detail about what on earth's gone on here.
Well, details are still emerging. We had a statement from the company in the last few minutes which elaborated a little bit on what may have gone on. It appears that, as you say, one of Arubis's business is to take bits of copper scrap and melt them down and return them into copper for people to use.
Which has to be part of the future for copper, doesn't it?
Absolutely.
Important market,
I mean, copper is absolutely vital to the electrification of the world. And I think it appears what has happened here is that they may not have been getting as much scrap as they thought, that some employees may be implicated in having diverted that scrap elsewhere. So it seems to be a case of fraud within the company, which the company is having to investigate. And of course, it comes in a year where we've had other large frauds in the metal business, most importantly Trafigura, which had to admit that nickel that it thought it owned turned out to be worthless scrap. And I think it just highlights again how these supply chains, metal supply chains, absolutely vital, as you say, Anna, are susceptible to fraud. And it's another example of a serious one. I mean,
and the risk of this is an industry-wide problem.
At a certain point, it appears to look that way. I mean, Arubis has said that the cost of this could top 100 million euros. It's a lot of money.
Anna.
Sorry, I was going to say, and I must wonder, I suppose, that as we rely more and more on the recycling of previously used copper and other metals, that as these supply chains will then become more complex, that maybe there is more vulnerability then built into the system, because you're not just buying the fresh stuff from one particular mine.
I mean, I think that the whole industry clearly is going to have to look at its procedures and get more serious about auditing exactly what it's buying and exactly where the metal is.
The copper price right now, Will, is gaining in the session about 1.4%. Is that as a result of this story, or is this a China stimulus measure response to the copper price?
I think it's the latter. I mean, clearly copper is a big barometer, or it's driven by the Chinese economy. China accounts for about half of global copper demand. So as soon as investors get slightly more optimistic or less pessimistic about the outlook for the Chinese economy, that tends to help the copper price.
Okay, and sticking with other things relevant to the commodities space, oil price is also heading higher. You know, maybe there's the China theme there, but up another 0.5% on Brent, 87.27. There's China demand, but there's also OPEC Plus in their supply. We've heard a bit from Russia.
Yeah, I think that's an important story. I mean, clearly the focus is always on how much Russia is going to contribute to OPEC Plus's desire to look after the market, to ensure price stability. It has cut exports over the summer. It has planned to taper those export cuts a little, but what's important here is it may continue to constrain its exports, which I think is important. Clearly, Saudi Arabia has decided to carry the biggest burden of these cuts, offering a voluntary 1 million barrel a day cut, and that's tightening the balances in the market. But if Russia can help more than the market expected, that's bullish, and I think it speaks to the strength of the alliance that continues between Riyadh and Moscow to stabilize.
So is this more of a supply story at this point, or is the demand from China?
Demand from China, I mean, how fast China demand grows is going to be absolutely crucial for the dynamics of the oil market through the rest of the year. But supply is important, and as I say, OPEC Plus remaining solid, and Russia and Saudi Arabia working together is important, especially to counterbalance some of the extra barrels that we've seen come out of Iran in recent months.
$87 a barrel now on Brent, 84 on WTI, up 0.5%. Will Kennedy, thank you very much indeed for walking us through the energy markets and metals as well, with the story around copper prices there popping 1.4%. Will Kennedy, our senior executive editor for energy and commodities. And linking to the commodity story, of course, is what's happening in China. And that country, officials, the PBOC, moving to support the yuan by cutting the amount of foreign currency deposits banks are required to hold in reserve. The move came hours after Beijing announced fresh stimulus for the beleaguered property sector and unveiled plans to expand tax breaks. For more then, let's cross over to Bloomberg's China economy and government editor Jill Desis in Hong Kong, where the windows are battened amid that storm. Jill, how significant then are these latest moves by the PBOC? They're putting more foreign currency into the markets. They're making the yuan a little bit more attractive. Is it going to be significant? Is it going to sustain, or at least put a floor under this currency?
Hey, Tom. Well, I think that at this point, it's at least it's an improvement, right? There's this idea that at least there's some measures that are being taken to support the currency. So hopefully that, that is somewhat effective. I think we saw a little bit of a lift earlier after that was announced. You can probably make an argument that with that FX triple R cut, with some of these property easing measures all being announced before market open in China today, maybe that's, sort of intended to help boost that sentiment. So I think at this point, obviously remember, Tom, that the yuan last month was climbing, or was falling to, its weakest level since 2007. So there's a lot of concern about whether this actually puts a floor under that depreciation. At this point, it does seem like the PBOC, I mean, they've said, like, they want to manage this well. They want to avoid any kind of excessive fluctuations. I think at this point, it's it's really a managed depreciation, right? But that's at least somewhat helpful there. And then I think when you take that in context with everything else that's been announced, the steady drumbeat of policies, these property easing measures, the cutting mortgage rates, trying to lower the down payment requirements for houses across China. All of that does come together to show that even if there's not a bazooka-style stimulus coming out of China, there is sort of this drip feed of policies that seems to be helping at least somewhat.
Okay, so we continue to watch the policy response there. That's part of the China story overnight, isn't it, Jill, around the currency and around the property market. We're also looking at data, though, coming out of China. And once again, a positive surprise, this time from the Caixin data set. What did that tell us?
Yeah, so this is a survey that measures manufacturing activity among smaller and export-oriented firms. And we saw it expand in August, which we really weren't expecting at this point. Now, I do have to point out, these surveys have been more positive than the official PMI, which measures other bigger firms. But ultimately, that return to expansion after a dip in July, certainly pretty encouraging there. I think what we were seeing in some of that underlying data for that Caixin PMI was that they were actually seeing a pickup in domestic demand, which was, obviously pretty helpful. And I think that when you take that survey in combination with the official PMI survey yesterday, which still showed a contraction, but it was it was better than we thought that it was going to be. It wasn't as bad. You saw some pickups in orders there. You also saw some pickups in production as well. I think all of that kind of goes to perhaps show that some of the recent policies that China has implemented to try to boost consumer goods manufacturing, boost the auto sector, maybe all of that's helping a little bit. I don't think that we're in a place where we can say definitively we're turning a corner or anything like that, but it certainly gives us a bit more room for positivity than we've had out of China in recent weeks.
Jill, China, the mainland, is in the midst of something of an economic storm. Our producer tells me, and using technical weather terms here, that it's looking quite typhoony in Hong Kong. You're there, batten down the hatches. How bad is it, Jill? What is the mood? What is the sense now on the ground in Hong Kong? And what are kind of the market implications as well?
Sure. So yes, we are all working from home at the moment. Transport is stopped because they've hoisted a typhoon signal, basically stopping a lot of local activity in Hong Kong. So it does appear to be becoming quite severe. Just a bit of drizzle outside my window right now, but what we're hearing from officials is that things are going to worsen as we get into the evening, into Saturday, overnight Saturday in Hong Kong. At this point, though, it's really interesting that so the Hong Kong Stock Exchange actually closes when you have these severe weather events. And so that's halting activity, obviously, not leaving a whole lot of room for markets to react to some of the data that we've seen out of China, for example. But it's kind of brought a lot of activity here to a halt. I know the government's considering looking at some of those measures, given how much trading happens electronically. But as for now, yes, we're all preparing to just kind of hunker down and see this one through.
Okay, we will, we wish you luck with that then, Jill, and everybody else in Hong Kong. Bloomberg's Jill Deese is in Hong Kong then, preparing for that super typhoon, which is, as she says, on its way. And China is the topic of today's big take story. Bloomberg has learned that the country's economic malaise is increasingly being seen as an opportunity by the West. The US and other G7 nations believe that Beijing's problems will strengthen their hand against a weakening geopolitical competitor. You can read more on that, sourced from various Western government spokespeople. You can read more of that on the Bloomberg terminal, of course. Just search for NI Big Take.
Okay, coming up, we get the latest on the fallout from the coup in Gabon after the military seized power from President Ali Bongo. That is next. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management, Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Markets Today. Happy Friday. We are 45 minutes into your trading day, and you're seeing a little bit of optimism coming through across the European benchmark, defying what the futures had set us up for. You're seeing gains of 0.2%, slightly more positive here in the UK, 7,467 on the FTSE 100, a gain of 0.4%, lifted by basic resources and energy. We're looking now at the data coming through from Italy. Italian manufacturing PMI for the month of August coming at 45.4, so just slightly softer than the survey of 45.7, above the previous month, but still, of course, firmly in contractionary territory, the manufacturing sector there in Italy, but not as bad as the print that came through from Spain in terms of the gap between the survey and the actual number. 45.4 for Italy, it was 46.5 for Spain, but it was the gap again between the expectations in Spain and the actual number that came through. So there you have it, the print for Italy and manufacturing for the month of August. Euro dollar currently gaining actually 108, just a gain of about 0.1% for the single currency. Anna.
We will get the French number and then the German number just before the end of this hour, so we'll see whether that still has a 3 handle. Now let's get on to other geopolitical matters, and the latest from Gabon, where a transitional leader is set to be sworn in on Monday, this after the military seized power from President Ali Bongo in a coup earlier this week. For more, we're joined now by our Africa correspondent Jennifer Sabasaja, who has details for us on the latest news here. Jen, good morning. So what do we know about Gabon's new leader who's been installed?
Yeah, so Anna, this is just a few days new, obviously, as you mentioned there. But what we know about him, his name is General Nguma. He is a distant cousin of Ali Bongo, and he was actually a former military officer and leader with Bongo's father, who, of course, as we know, was in power for 40 years or so. And so what he's saying is he's trying to continue to resume actions as if they're normal. But he did speak to a French newspaper yesterday saying that, in particular, he was trying to justify this attempted coup, saying that the Constitution was violated. The method of the election, which they had last week itself, was not good. And so he says the army decided to turn the page and to take responsibility on themselves. Now the question, though, really is what are stakeholders, what are international leaders going to do? Because we're just a few weeks out from what we saw in Niger, of course, and a lot of the intervention, a lot of the potential action that we saw trying to happen from other leaders did not necessarily overturn the situation that we had there. And so it's unclear whether or not what General Nguma is saying is going to sit well with leaders in particular.
Yeah, another day, or at least another week, and another coup out of this part of Africa. What has the market implication been, the market impact of this?
Yeah, I think we need to remember that although Gabon is a small country, it is a member of OPEC. It is an oil-producing nation, albeit quite small. But we did see a lot of reaction, though, from the markets throughout the past few days. We saw a number of French companies that have investments in the country. Their shares were a little bit jittery over the past few days. There you're taking a look at just oil oil at this point in time. But also, what's been a lot of the concern over the past few years, we've been talking about Gabon's conservation efforts. And in particular, I've been covering the fact that this country is almost 90% covered by forest. And so there's been a lot of investors, particularly invested into their carbon credit market. And so there was a lot of concern that any sort of conservation efforts, there was a debt for nature swap deal that was instituted in Gabon recently. And so the concern is now that this potential coup could potentially sideline any of Gabon's conservation efforts and potentially we might not be able to see Gabon be able to repay some of their debts. And so there's a lot of concern in the markets about what exactly is going to happen following this.
Okay, things for markets to watch.
Yeah.
You made the point that perhaps some of the things that Europe has said in the past should happen in the wake of coups hasn't necessarily happened and hasn't had any effect previously. So what are we hearing from other parts of the world then in terms of the response to this?
Yeah, in particular, what's been interesting is to see the reaction from France, right? Because a number of these coups attempted coups that we've been seeing are former French colonies. And so we've heard a number of leaders from the US, from France, and from the EU condemn this particular coup in Gabon. But what was really interesting, I found yesterday, was hearing from the EU Defense Chief, Joseph Borrell, who actually talked about how this situation is very distinct from Niger, what we saw recently. But in particular, he did denounce the election and saying that, this was not necessarily what this country needed at this point in time. And so, again, there's a number of countries that do not want to see any sort of coups or military takeovers in this part of the world because of the interest there. But it seems like there's a lot of division as to what needs to happen next and whether or not democracy is actually going to prevail in this part of the world.
Jen, thanks so much. Thanks for the update. Our Africa correspondent Jennifer Sabasaja with the latest on Gabon and tying it into the broader themes. French manufacturing PMI just hitting the Bloomberg 46. That again is a little lower than had been expected. We saw that with Spain earlier on where we had a lower than expected figure. So we'll keep an eye on these as we build towards a Eurozone number at the top of the next hour. Coming up on the programme, we'll look ahead to today's US jobs report for clues on the Fed's next steps. That's next. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome back. This is Markets Today. We are 53 minutes into a European trading day that looks broadly positive, a little more positive than it was at least. The London market gaining, metals and energy are doing okay for London. Elsewhere, we see modest gains, modest expectations on US futures as well, because we have the jobs report later. Let's talk about what's happening in markets today. Ven Ram from our Markets Live team joins us. Ven, okay, which do you think is going to be more important, the jobs report or the ISM data coming out of the US later on? I guess we know quite a lot of the bad news in manufacturing already, maybe.
Yes, absolutely, and I think that the jobs report is still the thing to watch for from the markets. I'm watching specifically for three things. Obviously, one is the headlines number. Look, we've had 2.5 years of unbroken expansion in the jobs market, and if we get a number along the lines that the markets are expecting, it's not going to move the needle too much for the Fed. The other is the jobless rate, which is far more crucial than the headlines number at this stage of the economic cycle. We have a jobless rate of around 3.5% now. The Fed thinks that rate needs to go to 4.5%, a full percentage point higher from where we are now, for the jobs market to come into balance, the macroeconomy to rebalance. And we haven't seen any evidence of that happening, and that needs to happen for the Fed to pivot. And that's a crucial number, therefore, to watch. The other thing, of course, to watch is the average hourly earnings. We have been bobbing around 4% plus, and obviously that has a lot of input on inflation.
Okay, Ven, we've got a print coming through we're just looking at the macro data here in the Eurozone. 39.1 in terms of German manufacturing PMI for the month of August, in line with the survey. But just a reminder of how weak German manufacturing is now, firmly and deeply in contractionary territory. 39.1, it is in line with the previous month. It is in line with the survey. The other three prints that came through for us this morning, Spain, Italy and France, all coming in below the surveys in all of those numbers, all of those data points, again, firmly in contractionary territory. Back to the US though, Ven, and your expectation, you've talked about the need, what is needed for that pivot from the Fed? What's needed for a pause at this point?
Well, I think that the Fed will pause in September. It's how much more ammunition they have in store beyond there. If the economy continues to be in this pattern, where in this holding pattern, where the long tail of the economy is playing out, where it's holding resilient, the jobs market is not losing its momentum, that's a problem for the Fed. And the risk is that they may go higher. You know, we talked earlier this week about how the Fed neutral rate in the US economy is going to accelerate to 2.5% by the end of this year from about 2% at the start of the year. That is a very big risk for the markets, and that is the Fed is acutely aware of that. So unless the jobs market comes into balance, it's going to be a hard trek for the markets here, trying to price a pivot.
Ben, we appreciate the context, as always, and the analysis. Ven Ram with that preview of the jobs numbers from our Markets Live team. Remember, of course, you can get up-to-date analysis and insight from Ven and the rest of the team. Just go to MLive Go on your terminal. European equities currently gaining 0.3%. Here in the UK, the FTSE 100 up 0.5%. US futures also pointing up. We've got live pictures, I believe, of Hong Kong, where they're looking to upgrade that typhoon. Stay with us.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Cernobbio on the shores of Lake Como in Italy with conversations that matter. Here's what's coming up on today's program. China ramps up efforts to stimulate its economy with the central bank trimming the amount of foreign currency deposits that banks are required to hold. Now, sentiment also gets a boost as a Chinese manufacturing gauge unexpectedly shows growth. European stocks, U.S. futures gain as traders, of course, await today's U.S. jobs report for clues on the Fed's next steps, with the data forecast to show the labor market cooled in August. Plus, former U.S. House Speaker Nancy Pelosi tells me the U.S. and China must learn how to work together despite a lack of shared values.
We don't have shared values, but we have a shared planet, and we have to work with the Chinese to save the planet.
Over the next hour, we'll of course be joined by some of the biggest names in economics right here at the Ambrosetti Forum in Cernobbio. First up, we'll speak to the French Secretary of State and former OECD chief economist Laurence Boone. Then at 9:30, we'll also be joined by Nobel Prize-winning economist Joseph Stiglitz. Then we'll also speak to another very famous economist and market-moving spokesperson at times, Nouriel Roubini. But first, let's take a look at the European markets. And for the moment, we're seeing gains across the board. Now, they're shy gains, but they're gains nonetheless. Stocks remaining higher. Again, everything depends on what we get from that key U.S. jobs data a little bit later on. And then we've had some encouraging news after the volatility of last week when it comes to what China's been doing. A bit of support there from China Day that was a bit better than expected. Again, today's payrolls numbers from the U.S. may provide further evidence of slight cooling in the still tight U.S. labor market. We're also getting manufacturing PMI for the euro area. That's for the month of August. 43.5. The preliminary reading was 43.7. This is not a great number because anything below 50, of course, indicates a contraction. Now, the former U.S. House Speaker, Nancy Pelosi, says the U.S. and Chinese leaders must learn to work together despite a lack of shared values. Now, in a wide-ranging interview, she also told us how Russia's invasion of Ukraine is, of course, a threat to democracy.
On security, what is happening in Ukraine is a challenge to democracy, not just there, not just in the EU, NATO countries, but really to the world. And what a tribute to democracy that the courage of the Ukrainian people are. What's frightening is that Putin does not share any values of democracy, of justice, of respect for the lives of people, concern for children or anything. And he's frightening, but it's doubly frightening is a person like the former president who thinks that's okay. Well, isn't that sad? But it's so sad and it's so extreme that it's everything to me is not frightening, but an opportunity.
An opportunity, but when you look at China, for example, if you look at what the U.S. has been doing with China and how they should treat China going forward.
Well, China's a big country, and and so are we, and we have to find an accommodation on how we treat each other. But in terms of the three things I named, security, China has been a violator of transferring technology of weapons of mass destruction to rogue countries, A. B, in terms of economics, they've been violated almost every trade standard of access, of piracy, of obeying WTA rules and the rest. And in terms of governance, what need I tell you, Hong Kong, Tibet, Uyghurs, threat to Taiwan, and the rest. So we don't have shared values, but we have a shared planet, and we have to work with the Chinese to save the planet, because they're now, I think, the biggest emitter. If not us, they're second, and they're part of the solution in all this.
Well, former House Speaker Nancy Pelosi also gave us her views on her political nemesis, Donald Trump, as he battles multiple legal challenges in his bid to regain the White House.
People are afraid of him now because, as you see, his desperation. In other words, it's one thing to say we have a disagreement on policy, okay, and we do. We have another thing to say that truth is not prevailing. But it's another thing to say there's a recognition of all the violations of the rule of law, that any person is above the law, undermining the press, which is the freedom of the press is the guardian of the gate of freedom. So he was clever. Undermine the press, undermine the rule of law. I'm above the law. So seeing the length to which he will go, of course, is more frightening. He's a threat to our democracy, but we intend to win.
He's so popular with the voters.
Well, he's popular among his group.
Are you surprised at how popular he is with?
Well, I'm never surprised. It's not a word I use. I just don't use. It's interesting to see how there's a certain element of the population who will just go for him. They're people we would probably never get. They don't share our values in terms of respect for the dignity and worth of every person and the rest. But there are some who are supporting him who are just afraid. They don't see a place for their families in the future. They're concerned about globalization. They're concerned about immigration. They're concerned about innovation. They're concerned about diversity, women, minorities, LGBTQ, other people coming into the leadership arena, and and that's to be respected. So I respect all of the people of America, and when people ask me, are you afraid of what might happen? I say no, because of the goodness of the American people, the strength of our democracy, we will prevail. And my motto is, the flag is still there, as we say in our national anthem.
Is there a Republican president, a candidate that you could live with?
I'm not into Republicans. I'm into the Democrats, and hopefully the Republican Party can find a candidate that America can live with. I say to the Republicans all the time, take back your party. The Republican Party is a great party. You've done great things for our country. You're not a cult to a thug. You're a great, grand, old party. And recapture that, because America needs a strong Republican Party. A strong Democratic Party too, but a strong Republican Party. So hopefully, as soon as we get through this, shall we say, cancerous situation that we're in, the malignancy of Trump, they will emerge in a strong way with the leadership that I know is there in the Republican Party. Not necessarily in the Congress, but in the country.
When you look at geopolitics, what scares you the most?
What scares me about what?
When you look at foreign affairs, geopolitics.
Oh, in foreign affairs. Well, in foreign affairs, anytime any of us travels abroad or receives dignitaries from overseas or grassroots activists, whoever it is, there are three things. One is security. Security, 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 so important. Security. Secondly is economics. How do we relate economically? Because that's the strength of all of our countries, to do so in a shared manner. And governance. Governance. What is the strength of the democracy in your country? How do you treat people and respect them? What is the integrity of your economic system? So those are the how we relate as Americans going abroad. On security, what is happening in Ukraine is a challenge to democracy, not just there, not just in the EU, NATO countries, but really to the world. And what a tribute to democracy that the courage of the Ukrainian people are. What's frightening is that Putin does not share any values of democracy, of justice, of respect for the lives of people, concern for children or anything. And he's frightening, but it's doubly frightening as a person like the former president who thinks that's okay. Well, isn't that sad? But it's so sad and it's so extreme that it's everything to me is not frightening, but an opportunity.
An opportunity, but when you look at China, for example, if you look at what the U.S. has been doing with China and how they should treat China going forward.
Well, China's a big country, and so are we, and we have to find an accommodation on how we treat each other. But in terms of the three things I named, security, China has been a violator of transferring technology of weapons of mass destruction to rogue countries, A. B, in terms of economics, they've been violated almost every trade standard of access, of piracy, of obeying WTA rules and the rest. And in terms of governance, what need I tell you, Hong Kong, Tibet, Uyghurs, threat to Taiwan, and the rest. So we don't have shared values, but we have a shared planet, right. And we have to work with the Chinese to save the planet, because they're now, I think, the biggest emitter. If not us, they're second, and they're part of the solution in all of this.
That was former U.S. House Speaker Nancy Pelosi. Now, coming up, we'll have plenty more from Chernobyl as European policymakers contend with rising fears of stagflation. We'll be speaking to Laurence Boone, French Secretary of State for European Affairs. She joins us live here from the Ambrosetti Forum in Chernobyl, close to Como. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in, but I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg. your global business authority.
So European policymakers increasingly being confronted, of course, by the dreaded reality of stagnating economies while inflation remains untamed. Now, speaking this morning, Bank of France Governor François Villeroy de Galhau says the ECB's options for its next meeting remain open, but the end of the rate hiking cycle is near. I'm very pleased now to be joined by Laurence Boone, French Secretary of State for European Affairs. She truly understands the economies like few people do in politics, because before she was also chief economist at the OECD. So Laurence, thank you so much, as always, for joining us. When you see the complexity of countries in Europe at the moment to deal with stagflation, to deal with all of these unknowns, what worries you the most?
So first, thanks for the invitation. It's a pleasure to see you, Francine. I think quite a few people do not value highly enough how we've gone through the crisis since Russia's invasion in Ukraine. We have been having growth, we have been securing energy, and at the end of the day, inflation starts to recede, as you were just mentioning. We expect French growth to be around 1%. And we will be reforming the electricity market to ensure that prices remain competitive for a long-lasting period. So overall, we've gone through this crisis with flying colors.
Are you surprised that we have done that? And is there a danger that actually it will come back to bite us a little bit later? So that, not we're complacent, but we think everything's okay, and then you're going to see companies really starting to hurt with refinancing costs.
So it is true that there is a cost. I think we've done really well. We've been acting swiftly to protect firms and consumers in the short term and to prepare the medium term as well. But it is true that it remains a difficult period with the uncertainty coming from the war, coming from China, and we have to be extremely careful and as reactive as we've been throughout last winter.
Do you worry about stagflation taking hold in Europe?
I'm quite optimistic, cautiously optimistic, because most of inflation, as you know, was coming from energy and has been spilling over in food as well. But we have been taking measures to address inflation. In the short term, most countries in Europe have put in place shelters against energy prices, and obviously that means that inflation recedes more slowly, but it is receding. And we have also been taking a lot of measures to boost investment and growth. The last step we have to do is to improve our budgetary policy, and I think that will be essential to address these headwinds.
I mean, overall, how do you think the relationship at the moment is between citizens and Europe? You're seeing, pockets of concerns here and there, either populist movements or noises about the cost of living, being blamed on Europe.
So one of the consequences of Russia's aggression against Ukraine has been high energy prices, and Vladimir Putin is weaponizing energy prices. We have to be aware of this, which is why it is super important to make sure that we can provide shields to consumers and to firms to maintain competitiveness and good jobs, and consumers so that their purchasing power remains as good as possible. I think we've done well so far, but we must be very vigilant precisely to avoid this rise in populism and to preserve the resilience of people.
But how do you match that with some of the budget? I mean, there's always a problem of finding the money.
This is obviously, there are two things. One is in the shorter term, we are reforming the budget rule, the fiscal rules in Europe, and I think that is important. We cannot keep with the pre-COVID, pre-war rules. We have to have rules that allow for growth, investment, and sustainable finances. And I think looking ahead into the medium term, we will have to move away from fiscal rules that are solely dedicated to preserve the euro to a true budgetary framework that will enable investment and raise potential growth in the energy transition period.
What worries you the most about the French economy right now? I know there's been a lot of, also images that were quite shocking on TV with burning Paris and riots.
So I think there's been riots all across Europe and even the world. You've seen them in the US, we've seen them in the UK, in Sweden, in Denmark. When these riots happened, I called my colleagues in the UK, Denmark and Sweden. We've done the same type of measures for the short term to repair as much as possible, as quickly as possible, and for the medium term to look at family and kids. What worries me is we need Ukraine to win Russia's war. I think that is the most important. It's about the geopolitical stability of the continent, because we've seen Russia before in Georgia, in Crimea. They cannot win this time. That is the security of the EU which is at stake. And that is where we have to focus most of our efforts.
How much more can Europe do on that front? I mean, many weapons have been sent, much support has been given.
So there's the training of soldiers as well. Then there will be the discussion about, gradually joining the EU as they are doing reforms and progress. We will continue to supply weapons. And then we are building our own security, right? No one was talking about a European defense only 2 years ago. And now we are putting the seeds of that with a lot of investment in the industry, or in defense industry.
So some people think that actually Vladimir Putin is trying to buy time in case President Trump, gets elected, and therefore it would change what's happening in Ukraine. How can Europe prepare for a potential eventuality like that?
But that's exactly the point when we discuss European sovereignty. It's about having competitive energy prices, a huge industry, and defense capacity within NATO, as an ally to NATO. But to be strong in our feet, 440 million consumers in Europe, 25,000 euro of GDP per head. We are the first economy in the world.
Laurence, as always, thank you so much for joining us. That was the Secretary of State for Europe for France. We'll have plenty more, of course, from Ambrosetti here in Chernobyl throughout the day. We'll speak to economists Nouriel Roubini, but also Joseph Stiglitz. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in Chernobyl, Italy today. Now let's get the latest from Gabon, where a transitional leader is set to be sworn in on Monday. Now this, of course, is after the military seized power from President Ali Bongo in a coup earlier this week. For more on all of this and the fallout, we're joined by our Africa correspondent, Jennifer Zabazaja. Jen, so what exactly is the latest on the situation, and what do we know about Gabon's new leader?
Yeah, Fran, this is still very early days, as you know, but what we have heard, we've heard from this new military leader. His name is General Nguma, and he's actually a distant cousin of the President Ali Bongo, who, of course, as you mentioned, was ousted. He also was serving as a military chief under Bongo's father, who was in rule for 41 years. So he is familiar to this country and especially to the administration. And what we heard actually this week, which was a bit surprising, was that the military leaders were trying to justify this takeover. And what they were saying is that, you know, not only was it the fact that they think the election that they had last week was rigged and was flawed, but they were also citing concerns around the president's health. And what we know about that, the president back about 5 years ago had suffered a stroke. And so a lot of the opposition leading up to this election was concerned about whether or not he was fit to serve. And so what we heard from the general on Thursday in a French newspaper was that he said the Constitution was violated, the method of the election itself was not good, and so the army decided to turn the page. And so now really what we are waiting to see is how the international community is going to respond. We've heard from the U.S., we've heard from the EU, all condemning this coup, this attempted coup takeover. But now the question is whether or not we're actually going to be sanctions imposed, especially because the military leaders are trying to instill some sort of normalcy into what this takeover has played out to be over the past few days.
Jen, thank you so much. Our Bloomberg Africa correspondent, Jennifer Zabazaja. Now we'll have plenty more from Chernobyl here on the shores of Como. Coming up, we discuss China's economic troubles and the global impact with world-renowned economist Joseph Stiglitz. Don't miss that interview, that conversation, next right here from Chernobyl, Italy. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg. Well, China ramps up efforts to stimulate the economy, with the central bank trimming the amount of foreign currency deposits that actually banks are required to hold. Sentiment also gets a boost as the Chinese manufacturing gauge unexpectedly shows growth. European stocks and U.S. futures gain as traders await today's U.S. jobs report for clues on the Fed's next steps, with the data forecast to show the labor market cooling a little bit in August. Plus, former U.S. House Speaker Nancy Pelosi tells me the U.S. and China must learn how to work together despite a lack of shared values. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Chernobyl, Italy, for the Ambrosetti Forum. So China has ramped up efforts to stimulate the economy and support the yuan. It's cut the amount of foreign currency deposit that banks are required to hold on reserve. Beijing has also announced fresh stimulus for the beleaguered property sector and unveiled plans to expand tax breaks. It's the latest in a long line of moves to shore up confidence in the world's second largest economy. Now, to discuss this and much more, I'm very pleased to be joined by Nobel Prize-winning economist Joseph Stiglitz. Thank you so much for joining us. Professor, there's so much to talk about China, but actually they've put measures and it's unclear whether they will work. Are they targeting the wrong things, or is it just a structural problem that they need to address first?
I think there is a structural problem that they need to address. China has sometimes been analogized to riding a bicycle. If you're going at 7%, everything is going well. Very hard to ride a bicycle at a very slow speed. And for 40 years, the mentality has been a high-speed system. So when you have a high-speed system, you build property well in advance of what you need. You make mistakes. 6 months later, a year later, those mistakes are corrected because there's so much demand. Now they have to do a better job of fine-tuning, and I think their system is not well adapted to doing that, particularly under President Xi, who has dismissed a large fraction of his economic experts.
But, Professor, so is this, first of all, a political decision, right? So he wanted to consolidate power, and he could only do that possibly if the economy was strong. So does he change now that he has more control, or do you think he's weakened because of a weaker economy?
I think he's surely weakened, but that doesn't say how he will respond. When you feel things are not going your way, you may respond in a more, quote, stronger way that may actually be adverse to the real performance of the economy. Steering an economy of the size of China is not easy. China, in what we call PPP, purchasing power parity, a way of trying to equivalize different economies, is larger than the United States. No one would even conceive of trying to steer this monster. But China, President Xi thinks he can do that kind of steering, and, I'm suspect.
Yeah, but by saying you're suspect, then are you expecting a lot of, concern, a lot of volatility with China? And what does that mean for the rest of the world?
Well, I'm expecting, and I have been expecting exactly what we've been seeing, that they tried.
You called it, yes.
They tried this, it doesn't work. Yeah. They do a little bit too much of that, and then they get worried, and then they go back to this. They shut down part of the tech sector. There's it's not just what we're talking about here. It's not just the property sector, which is a very large part of the economy, but it's many other sectors of the economy.
But Professor, is the only way then to slow the economy, right, to be able to readjust? And what are the impacts for the U.S., the Fed, and Europe?
Well, I think we have to remember that in the 2008 economic downturn, China was the source of engine for the global recovery. It was pivotal. It won't be there. And in fact, I worry it will be dragging down the global economy. And that's one of the reasons that I'm so concerned about what has been going on in monetary authorities, particularly in the United States, that they've pretended that nothing's going on in the rest of the world. They've been raising interest rates well beyond anything that is reasonable, and have put at peril, particularly, I think, the European economy. I think America is going to do okay, but I worry about Europe.
But with all due respect, the Fed has two mandates, jobs and inflation. Jobs are okay, and they need to handle inflation.
The source of the inflation in the United States, going back to the pandemic, were a series of supply-side interruptions, major demand shifts. When I say demand shifts, people were demanding, for instance, housing in different places. The aggregate demand was not that high. The aggregate demand for housing, for instance, we killed off more than 1 million people. That should lower the aggregate demand, but they wanted houses where they weren't, where it's in the supply. You don't solve that problem by raising interest rates. That reduces the supply to meet the demand. So the Fed, from the very beginning, had a misconception of that this was an ordinary inflation, excess demand, and responded wrongly. The result of that is our inflation has come down, but it has nothing to do with the Fed. It has basically because we resolved the supply side problem.
So if you're telling me, Professor, that you think that the Fed has hiked interest rates too much, I think you use the words, beyond what is reasonable. Will it crush the economy further down the line?
It's clearly going to weaken the economy down the line. How much we don't know, because as we always say, there are long and variable legs. In the United States, we're lucky that fiscal policy has been very good. And we've had a couple surprises on the positive side. The IRA, the bill to support green investment, has proven to be far more effective than anybody anticipated. They thought, the CBO thought it was going to be a $271 billion over 10 years, big. Turned out current estimates are over $1 trillion. So we are lucky that Joe Biden got things right. The Fed got things wrong, but the two are going to balance out. But for Europe, things look very different because you don't have that strong fiscal policy, and so I do worry.
So do you worry? Do you think the ECB made policy mistakes?
I think that they were in a corner. If you don't match the United States, the exchange rate weakens, that exacerbates the inflationary pressures. There are always strong forces to sort of keep your interest rates in line. But I think judging where I see the differences in circumstances, it is a mistake for the ECB to try to keep up. It's better for there to allow a little bit more inflation and to protect the economy.
Do you think stagflation, I mean, this is like, it haunts nightmare for central banks. Do you think stagflation will take hold in Europe?
I worry about that, but I don't worry about it in the long run. We're still going through, you might say, a trauma. We're recovering from two major assaults, the pandemic and the supply side shortages that gave rise to, and the war in Ukraine. Europe has adapted well to both of those. The trauma is not over. I think there were some major mistakes Europe made, especially in the energy market, in responding, that have made stagflation much greater a risk than in other places.
Professor, if you look at the Bank of England, does the UK have it hardest than all?
Yes, they do, because on top of all the other trauma, they have a self-inflicted trauma of Brexit. And, it's just fully coming into force, and we're beginning to see the problems, but they come on top of the other two problems, which were clearly not anticipated when they voted for the separation.
So what does it mean for the Bank of England?
As you say, they have a real quandary. My own view is that growth at this juncture is more important than inflation, that it's a relatively small open economy. When inflation is tamed in the United States and tamed in EU, that will spill over and help bring down inflation in the UK.
Professor, thank you so much, as always, for joining us. That was the Nobel Prize-winning economist Joseph Stiglitz talking for us about China, the US, Europe, and the UK. We'll have plenty more from Chernobyl here at the Ambrosetti Forum throughout the morning. This is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Welcome back to The Pulse, the conversations that matter, the insights you need. I'm Francine Lacqua, and this time we're here on the shores of Lake Como in Cernobbio, Italy. Now, there's one man that I always enjoy catching up with here in Cernobbio. It's a biannual event, and he always doesn't really give me hope. He kind of says the things as they are, and sometimes they pan out, especially after the post-traumatic events of COVID and that interest rate rise. He is Nouriel Roubini, and he joins me once again. Nouriel, thank you so much for joining us. I mean, it's always fun catching up, although you're never that positive about the world economy. Are you more positive now than you were 6 months ago, or less?
Well, I would say that compared to 6 months ago, where there was a serious risk of a real hard landing for the global economy, those risks are reduced right now.
No.
That's the good news. But I think that there's still an open discussion on whether the global economy is going to achieve a soft landing as opposed to a bumpy landing, where a bumpy landing will be a short and shallow recession. That short and shallow recession has already started in the Eurozone. The UK, with very high inflation, is probably headed towards that recession as well. In China, there is a sharp slowdown of growth. It's not just cyclical, it's more structural. United States, still, the jury's out on whether we'll achieve a soft landing or whether there's going to be a short and shallow recession. So it's a mixed bag.
But that depends on what? So in the U.S., is it Fed policy, or is it just a tight labor market that could suddenly collapse?
Well, in the U.S., paradoxically, so far, in spite of Fed hiking rates above 5%, the economy has grown recently above potential. Tight labor market, tight goods market. That's good news in terms of achieving a soft landing, but it's actually bad news for the Fed because it implies that the Fed is not done yet. They may have to hike once more, maybe twice more. Eventually, the Fed funds rate might have a 6 handle rather than a 5 one. And the more that happens, the more the risk that eventually there might be at least a short and shallow recession. But the economic data recently have been reasonably strong, even if it's slowing.
But Nouriel, I don't really understand what's changed in the last 6 months. So there could be a delayed effect of all the interest rate rises with defaults in companies, and the data from China could point to a much worse economic picture. So why are you now more positive than 6 months ago?
Well, there has been a bit of unwinding of the negative supply shocks that occurred during COVID. Commodity prices fell. Some of the supply bottleneck have been reduced and so on. That was positive. Fiscal policy has been reasonably expansionary in the United States, but also in other parts of the world, keeping demand stronger while the Fed and other central banks were tightening. Some of the geopolitical tensions have been somehow reduced.
How odd is that? The fact that a lot of these adjustments have happened by themselves.
Well, we knew there would be some unwinding of the COVID shocks that implied initially lower growth and higher inflation, now lower inflation and higher economic growth. But certainly it's been surprising that given the amount of monetary tightening, some economies have been resilient. But the most resilient economies in the United States, as I pointed out, the Eurozone is going towards a short and shallow recession. UK, China is a structural problem. So you cannot generalize what's happening right now in the global economy. The US is probably the brightest spot as of now.
Is there anything in Europe that policymakers can do to avoid stagflation, or at least make it shorter?
Well, the reasons why we have stagflations are more structural rather than being cyclical or anything to do with monetary or fiscal policy. There is process of deglobalization, there is decoupling, de-risking, geopolitical depression, restriction to essentially migration, there is reshoring and friendshoring of manufacturing, there is global climate change. Those are all structural factors that over medium term reduce growth and increase cost of production. And the structural reforms that increase actually potential growth are occurring too slowly. Technology in the future is going to be a force for stronger growth and lower inflation. AI, machine learning, robotic, automation, quantum, biotech, and you name it. But the effects of that on growth and inflation is going to take time. In the short run, the stagflationary forces are more important in some parts of the world.
What do you make of China right now, and what are markets most misunderstanding about the world economy and actually how equities and bonds should behave?
Well, China, the reduction in growth is not cyclical, it's structural. It has to do with aging of population, debt and leverage, housing overhang, state capitalism, a backlash against the private sector that depresses the sentiment of household and the corporate, geopolitical depression, the policies that are effectively Marxist-Leninist of Xi Jinping and so on. So I think that potential growth used to be 10, went to 5. I think it's at best 3 to 4%, and that's not going to change because he's emphasizing security control over opening up and reform. That's the main thing.
Yeah.
I would say on markets, in my view, if the global economy is going to weaken, if there is still a meaningful chance of at least a bumpy landing. Probably markets have rallied too much today, and that's maybe going to lead to a correction in the second half of the year. If the economic data are still weak, and if central banks have to hike a little bit more as a way of essentially fighting inflation, and that's going to lead to a nominal and real rates rising as well. And that means that probably bond yields may go higher rather than lower, while inflation is still high and central banks are still fighting inflation.
But a correction, what, a 10% correction in equity markets, or is that too high?
Well, a 10% correction is not totally unlikely. If the economy starts to soften up globally, and if you have still inflation that is above essentially target, with core being still high in US, UK, Europe, central banks hiking somehow more, I would not be surprised if in the second half of the year you get a 10% correction in global equity markets.
So what would you do if you were Bank of England governor?
Well, Bank of England is facing a dilemma. On one side, growth is lower, and is lower also because of a self-inflicted goal that was the Brexit decision by the UK to reduce potential growth and increase cost of production. So it's the most likely case of stagflation. On one side, the economy is headed towards a sharp slowdown, potential recession. On the other side, core inflation is still too high, and therefore you face a dilemma, or a trilemma in the case of the Bank of England, because you want to have lower inflation, but that's going to cause a recession, and higher interest rates are going to imply eventually financial instability, because private and public debts are high, and debt servicing ratio are going to rise as interest rates go higher. So you might have actually a perfect storm in the case of the UK.
Is there anything that actually fiscal policy or just government policy can do to try and mitigate that?
Well, fiscal policies are also in a dilemma, because if you want to maintain growth, you should have expansionary fiscal policy, but now fiscal policy at cross purposes with monetary policy. If you have too much essential inflation, it's because there was too much demand. That implies that cyclically, structurally, fiscal policy should be retrenching. The opposite is happening, and that's make the goal of central banks of achieving price stability harder rather than easier.
Okay, but so what does the UK economy look like in 2-3 years? How do they build the economy also to make up maybe some of that lost output?
Well, the reality is that you'll have to effectively reverse de facto, if not de jure, Brexit, maybe have a custom unions.
That won't happen? Do you see that happening?
Well, you know, people talk about Brino, Brexit in name only. If Labour were to come to power, probably they're not going to reverse formally Brexit, but probably the relation with Europe is going to improve. Maybe there is a chance of eventually going to a custom union of that sort. And UK has to do, like everybody else, structural reforms to increase potential growth. I must say that actually in some of the technologies of the future, like AI, biotech, the UK has actually lots of great academic research, venture capital, firms, startups, and that's where actually the UK should emphasize. Its strength is going to be to have the kind of reform that lead to technology and innovation, and if they do it done right, they can do it.
Bank of Japan, how much of a nightmare is it trying to go against everyone else? Will they just have to, you know, give up on yield curve control soon?
Well, they will give up on yield control, but they're still waiting to see whether this increase in inflation and core is persistent or not. I think they will gradually phase out the YCC for the 10-year JGBs and then go to the 5-year over the next 6 months. So, yeah, they're still behind the curve, but inflation is still moderate in Japan. I don't worry them being behind the curve, and they're worried about making a mistake of phasing it out too soon, and then maybe if inflation is too low, then they have to reverse themselves. So I think they're going to get it mostly right.
Nouriel, as always, thank you so much for joining us. Nouriel Roubini, their chief executive of Roubini Macro Associates. We're also on a panel together, so Nouriel has to get off and go on stage, and I'll join him very shortly. Later today, we'll be discussing Italy's surprise windfall tax on banks with the Intesa Sanpaolo chairman. He's Gianmaria Grospietro. That exclusive interview coming up. That's at 12:45 p.m. UK time, and this is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
The markets are, in my view, overly concerned about Italian banks. This has happened several times in the last few years. Nevertheless, it is a serious problem. I think some intervention on bad loans is necessary, but above all, it's necessary not to mess up things in the financial markets.
Well, that was the former Italian Prime Minister and Senator for Life, Mario Monti, speaking to me here earlier about the surprise windfall tax on Italian banks. We'll have plenty more, of course, from Cernobbio at the Ambrosetti conference. I'm also looking forward to speaking to the chair of Intesa. They were one of the biggest banks that were affected by this windfall tax, and I think it's one of the first times that he speaks to the press. That's a little bit later on today. Now, stocks are edging higher overall. Again, it's U.S. jobs data day, so we were lucky to speak to Professor Stiglitz about it. We were lucky to speak to also Mohamed El-Arian. Markets settling into a bit of a holding pattern ahead of this U.S. jobs data. European stocks, but also futures in the U.S. edging a little bit higher. Treasury yields pretty much flat. Now, look, the payroll reports may provide really further evidence of a slight cooling in the still tight U.S. labor market. And of course, this has implications for the Fed. Coming up later this morning, Bloomberg has an exclusive interview with the U.S. ambassador to the EU, Mark Giltenstein. That's at 10:40 a.m. UK time. Then later today, we speak also Italian banks and that windfall tax with Intesa chair Gianmaria Grospietro. This is Bloomberg.
Politics.
We're not going to be relying
upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lyons.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
Breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. A string of critical economic data this week wraps up with the U.S. jobs report, if we can get there. Yellow's bankruptcy and a strike in Hollywood likely created a drag on hiring. So as we move past that critical data, we're also going to be looking at the ECB's dilemma. We've had data come in there too, and plenty of ECB speak. Finally, the data also improves in China. At the same time, manufacturing looks better as China moves to ramp up its efforts to support its economy and its currency. Well, good morning, everyone. You made it to Friday. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Simone Foxman is in New York. Simone, I don't get the long weekend. I guess I don't need it since I was just on holiday, but for those that do, you really had to work for it given the twists and turns between markets and all the data deluge we've gotten this week.
Yeah, I've certainly been working for it all week, but there's lots of conflicting data out there. How much are we going to get an impact of this Taylor Swift, Beyonce-driven economy? How much are we going to see the impact of the Yellow bankruptcy, et cetera? We may get some sign of that this morning. We're looking at stocks, S&P futures pointing slightly higher. Of course, all eyes on that crucial jobs report. The expectation is for non-farm payrolls to rise by 170,000. That would keep the unemployment rate at 3.5%. So we're paying a lot of attention to that. U.S. 2 years held their gain, yields under 4.9% as we speak, and the dollar index slightly higher here, just a touch. Kit Jukes of SocGen telling us earlier this week, however, that if we see a particularly strong jobs data number, we could see the dollar rally. Of course, watching Brent crude, $87.30 a barrel here, supported by Russia agreeing to extend its OPEC its production cuts, But as you mentioned, Labor Day weekend, Danny, folks in the United States taking to the road, and they are nearing, according to AAA, a record high for prices that they are going to pay at the pump on a seasonally adjusted basis.
How could you take to the road today when at 8:30 a.m. Eastern you've got a jobs report? Come on, folks, you got to stay glued to your terminal at least until that moment. Then you can go away to the lake, to the beach, or wherever you're going. Simone, I'm going to kick off at the last thing on my board since you ended with oil. I should say, getting commodities excited, it's not just the OPEC Plus news, it's also the stimulus coming out of China. We're going to talk to Simon White about that in just a moment. You can see it's helping out Dr. Copper. It counts as my European board because it's on the LME, up 1 1/3%. Bringing it back to Europe, not a lot of movement today. We've seen this push and pull of the doves really taking over yesterday. Those Schnabel comments. It means that stagflation potentially isn't just a concern that's being priced in by traders. It's something that's being discussed by the ECB. It was also in the accounts of the last ECB meeting. But it does mean we've taken a little bit of a breather, a little bit of a pause, perhaps reflecting of waiting for that American data. Euro versus the dollar slightly stronger, while 10-year yields, Simone, push higher by about a basis point.
Thanks, Danny. Yeah, let's turn to China as the country intensifies its efforts to stimulate the economy and support its currency. Joining us now to discuss is Bloomberg macro strategist Simon White. Simon, talk me through some of the latest moves by the Chinese government here to support their economy.
Sure, yeah. I mean, they're trying to achieve at least 3 things. So they want to stabilize their currency. So we saw the reduction in the foreign exchange required reserve ratio to do that. They want to support the property market. You know, it's a really big issue in China. They want to prevent debt deflation. So we saw some moves in that respect to, you know, reduce mortgage rates, down payments on, apartment blocks. Like down payments in China, the tier 1 cities are still 30 or 40%. So they're still quite big kind of, it's a big difference there to reduce that. And finally, also they want to boost consumption. So we saw some tax breaks. So it's really, we're beginning to, incrementally move in the direction. So they're really trying to target the stimulus. They're trying to, not go down the route of flood-like stimulus. But really it's building. And at some point, I think it might even have a tipping point effect, and it really does begin to bite. We're not there yet, but they really are trying to do a big deal here.
It does seem like markets have started to move in that direction. At least China-related markets are kind of the only thing moving today because we're still just waiting for that U.S. jobs report. Help us set things up for the U.S. What's at stake here with this set of data?
Yeah, I mean, look, it's going to be very tricky for there to be, a very positive number. Seasonally, it's very negative, August, for payrolls. But really, if you look at the trend, the year-on-year trend of payrolls, it's trending down. It's been trending down quite sharply. At the current trend, you get a negative number by the end of the year, a negative payrolls print on the month. But you might get one earlier. We've now got strikes coming through, so that's really putting negative pressure. But the things I'm watching are temporary help and average hour works. So they're the more leading aspects of the jobs report. So both have been declining. Temporary help is contracting on an annual basis already. And hours worked has been steadily declining over the last year and a half. So I'm going to be looking to them because people tend to cut hours before they sack people, and they tend to cut the temporary workers before they do a proper layoff. So they're really the more leading parts and the more interesting parts of the report.
Don't you think the bond bears are just going to have to send Taylor Swift a thank you message?
Yeah,
Thanks for making sure the numbers didn't cool off too much.
Yeah, exactly.
That story's crazy. We're going to talk about it more throughout the show because it's probably the most fun aspect of the jobs report. Simon, thank you so much. Simon White there breaking it down for us. We also had a slew of data already out of Europe. It was manufacturing PMI. The region continues its sustained contraction. Perhaps no surprise there. Joining us now is Bloomberg's European correspondent, Maria Tadeo. Maria, we knew it was going to be bad. How bad was it?
We knew it was going to be bad because this manufacturing picture for the euro area has been a dismal one for months now. A lot of that pegged in conjunction with the energy crisis, which, as you know very well, has really shaken a lot of the industrial names in Europe. Now, when you look at the numbers that we got today, PMIs, manufacturing PMIs for August, you look at the euro area, you look at Italy, you look at Spain, you look at France, they are obviously in contraction, but obviously come in deeper in contraction compared to the estimates. So they're all hovering, of course, below that 50 mark, but also going further below compared to those estimates, perhaps suggesting that the pain is not moving anywhere when it comes to the euro area. The other number that I would point to is, of course, the German manufacturing data that we also got today. It's really stuck in that deep contraction threshold below 40 for those PMIs. This is still a story that is hurting the biggest economy in Europe. And again, it paints a complicated picture for growth. Some of that also confirmed with the Italian GDP numbers that we got, again, pointing to an economy that is in deceleration. And there's still the biggest question, which is what happens in the back end of the year? Do we get a downturn that further manifests in the euro area? A lot of this, of course, complicated matters for the European Central Bank, which, as you know, focuses and will focus on that 2% inflation target. But obviously, they operate in a macro environment where now it is very clear it's pointing to the downside. To me, I'll be very interested and curious to see those new forecasts and projections by the ECB in September in terms of the trend over the medium term and just how dire they predict the European economy will be over that near term.
Maria, we had Robert Holtzman of the ECB talking about how the bank shouldn't pause in September, should continue to hike. But at the same time, we've got Morgan Stanley saying they've erased their projections of a hike going forward. How are the other governing council members positioning?
Yeah, Morgan Stanley has changed its call. They say now that they do not expect a rate hike in September. Remember, this is an open field between that hold or a hike by the European Central Bank. What they cite is the kind of data that I just referred to, this weaker economic growth for the euro area, coupled with the fact that it does seem that some of the services inflation seems to be cooling. Putting all of that together, the ECB could make a case to hold in September. I should say I still talk to people who say they still believe there would be a final one in September. So again, some of that debate, I'm pretty sure, will linger almost all the way to decision day. And then that takes me to some of the commentary that we've had over the, well, recent days, but also will continue, expected to continue next week, because a lot of governing council members are expected to deliver speeches. When you listen to the French head of the central bank, Villeroy de Gallo, he says that at this point, he has not made his mind yet going into that September decision. So again, a lot of that still seems to be pending in this governing council. To me, it seems that, again, this will be a decision that is going to keep us on our toes, which is great news for us, of course, I guess, working at Bloomberg TV until that decision day expected on September 14th. But again, we're getting to a point where it's almost every data point matters, and we have to look at every piece of data that we get all the way to that September meeting.
Come on, Maria, you get enough sleepless nights. We could use more certainty in this world.
It's a good point. I didn't want to say it, but you said it.
Okay, Maria Tadeo, thank you so much for that. As always, we're going to hear from Maria a little bit later in the show, too. All right, let's turn to geopolitics. Russian President Vladimir Putin is moving quickly to take control of the deceased Wagner chief Yevgeny Prigozhin's operations in Africa and the Middle East. Joining us now is Mark Champion of Bloomberg Opinion. Mark, what can you tell us about what exactly Putin is doing in this instance?
Well, so there is a large, by now, network of operations that was run by Wagner. And this was a sort of arm's-length operation funded by the Kremlin, often following Kremlin foreign policy priorities, but also a money-making business for Prigozhin and for the state. And there was an element of deniability there. Wagner was, both very effective, but it was also as a tool, but it was also quite controversial. It was, singled out in accusations of murder, rape, etc. So now that Prigozhin is dead, and some of the other top leaders and founders of the organization are dead, the state is trying to absorb Wagner, and these will now become Russian operations. So they're not going to go away. They could even deepen. They could even become better funded. What we don't know is how all of the Wagner units will respond. We don't know if they'll all want to join the defense ministry, if they won't. But they're fairly well paid. They're mercenaries. No doubt the government will continue to do that. And this is a very valuable operation. And I think the essential thing to think about, to understand about it is that the deniability is probably not worth as much as it was before the war in Ukraine. By now, trying to maintain image is not extremely important. In one sense, there's change and no change.
Mark, speaking of image, Putin has already confirmed he won't be attending next week's G20 meeting in New Delhi. But actually, now it appears that Chinese President Xi Jinping, according to Bloomberg reports, won't be expected to attend either. What does Xi's absence mean for the summit?
Yeah, it's a very interesting question. I mean, it's a G20 summit, so it's one of these events that will end with a statement, and there'll be a lot of argument over the text and so on. In terms of what comes out as a statement, it may not make a lot of difference at all. It will matter to Narendra Modi, the leader in India, for whom this will be a bit of a snub. Not having Xi there will also be a kind of devaluation of the G20. China is by now, at least the second most important country to attend after the United States. In those senses, it is interesting that he was willing to go to the BRICS summit, which expanded in a way that China wanted, and where China is really the dominant player. And he was willing to go and do that, but he's not willing to go to India, where he has a lot of different tensions. Won't be the dominant player. He'll be one of them.
Yeah, such an interesting point, Mark. Thank you so much. That's Mark Champion of Bloomberg Opinion. All right, coming up later this hour, we're going to get the latest on the war in Ukraine and more in an exclusive interview with Mark Gedenstein, U.S. ambassador to the EU. Plus, what to expect from the U.S. jobs report today with Klaus Bader, global chief economist at SocGen. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis.
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Are on the U.S. jobs report.
We're still seeing some lingering effects of the pandemic on the jobs market.
There has been a shift to labor, and it doesn't seem to be diminishing.
This labor market is still tight.
Today, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Are we beyond COVID?
We are on that path to get to lower inflation by the end of the year.
But then you look at the unemployment rate, you're looking at a problem for the Fed.
The August jobs report, today on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Simone Foxman in New York. So Broadcom shares, they're falling in the pre-market. The Apple chip supplier had given us a downbeat forecast, one enough to send shares lower by more than 4.5%. Let's get the details with Matt Bloxham of Bloomberg Intelligence. Matt, what drove this? Because it seems like there are some things that would help. The AI boom being a big one. So what was enough to counteract that?
Well, I mean, pardon the pun, but Broadcom is a very broad business.
I knew you were going to go there.
Yeah,
you are forgiven.
Yeah, and so what you're seeing is good growth in the AI segment. Yeah, that's clearly where all of their demand is coming from. But on the counter side, they're a very big supplier to Apple. The smartphone market in general is being quite soft this year, expected to continue to be a bit soft. So that's kind of counterbalancing the overall trend. So they saw sales growth of about 5% this quarter. They're forecasting about 5% growth next quarter, which is consistent with analyst expectations. Obviously, what we saw with NVIDIA and others was like a big beat on sales. So, the momentum is there from AI, but it's probably not as strong as it is with NVIDIA, and it's being counteracted by some of these kind of more muted trends we're seeing elsewhere in the technology market.
Matt, let's shift to the ARM IPO, because it looks like we could get that in just a couple of weeks. September 13th, I believe, might be the date. Can the chip designer get the $70 billion valuation that they're looking for?
Good question, and obviously next week they're expected to kind of launch their management roadshow, and I think that's going to be what answers that question. People are going to have a chance to really probe management, understand the business more, understand how things like AI might drive the midterm growth, and figure out where they want to price it. And obviously this has broader implications than just for SoftBank. This is for the wider IPO market in general. So there's a number of companies lining up wanting to do IPOs too, and also a lot of bankers that have been living off kind of meager kind of food for the last year or two, because the IPO market's been pretty quiet. So I think there's a lot riding on investor appetite for this IPO as a signal for the wider health of the capital market conditions.
Yeah, I've heard again and again, post-summer things will come back. This is going to be the test for sure.
Absolutely.
Matt, thank you so much. Matt Bloxham there from our Bloomberg Intelligence team. Let's get to a Bloomberg scoop. Let's be honest, an insane scoop. Simone and I have been talking about it all morning. The European aviation regulators have determined an obscure London-based company supplied bogus parts for repairs of jet engines that power many older generation Airbus A320 and Boeing 737 planes. Something that's very worrying. Joining us now is our senior aviation reporter in London, Sid Phillips, who's in the team that broke the story. Sid, look, like so much to discuss here, but I got to start with the question I'm sure is on everybody's minds. If I'm getting on a plane today or tomorrow, what is the risk that I'm flying on a plane with a fake spare part, and what would be the risk of that?
So at the moment, it's not really safety critical. The regulators have said it's not really safety critical, but they are looking into it, and they've asked airlines to look into their sort of engine records and make sure that if there is parts supplied by this London-based company called AOG Technics, essentially they're removed and isolated and essentially replaced by legitimate parts. And that's because the aviation regulator in Europe, EASA, has said that numerous authorized release certificates, which basically accompany parts, have been forged. And essentially, in each case, the regulators found that the parts, the certification that was identified was not produced by the manufacturers, and they also did not ship those parts. So it is a seemingly worrying situation, but at the same time, it doesn't really impact flight safety because regulators are on top of it.
Sid, I'm glad to hear that it doesn't impact flight safety, but how could this have happened?
So think of it like a car. So when you send your car for servicing after you bought it from a company, you send it to a garage that uses parts that it may or may not have got from the company. In this case, it's much more critical because your car isn't flying at 35,000 feet. And so it is the aviation industry is basically, it looks at every single component, and every single component is certified. Every single component has a proven origin. And that's really the bedrock of the aviation industry's safety record. And essentially, if you have unknown parts, you do not know whether or not they will conform to the specifications they're meant to conform to. And so that is really the key concern here.
Sid, a really great story. Siddhartha Phillip there. Thank you so much for that scoop. One that, now that I've heard from Sid, it's not going to keep me up at night. So at least I'm happy about that. All right, coming up, Wall Street is starting to put more pressure on workers to get back to their desks. Summer is over, folks. We're going to discuss that next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Simone Foxman is in New York. Simone, it's the end of the summer. It is September, and the story that caught my eye on that front, we have a whole lot of banks coming out, a whole lot of Wall Street demanding that those who've decided to stay at work come back into the office. It feels like it's getting anew, this return to work story. It's really picking up steam yet again.
Yeah, apparently return to office now coming up in mid-year review conversations for bankers. Most banks determining you have to be back at least 3, maybe 4, sometimes 5 days a week. But Danny, I should mention, I don't think the summer is over until after Labor Day, I have to say.
As someone who doesn't live in America anymore, I've lost all concept of time, but that sounds fair to me. It definitely does. All right, coming up, we're going to get back to the markets conversation with Klaus Potter, Global Chief Economist at Societe Generale. This is Bloomberg.
Middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang1 yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A string of critical economic data this week wraps up with the U.S. jobs report. Yellow's bankruptcy and a strike in Hollywood likely created a drag on hiring. Meanwhile, ECB officials are weighing their options as they decide whether or not to raise rates on September 14th. Fresh manufacturing data this morning added fuel to that debate. And China ramps up efforts to support the economy and its currency. Sentiment also gets a boost from yet another set of manufacturing data that beats expectations. I'm Simone Foxman in New York with Danny Berger in London. You know, Danny, we've been so focused all week here in the U.S. on what is going to happen to this crucial jobs report, but I feel like there's so many more question marks right now in Europe.
Yeah, a lot more concerning things in Europe, I should say. At least in the U.S., the data seems to be moving in the right direction. For Europe, it's not. Inflation is still stuck for many regions in that 5 to 6% range. Growth numbers still look bad. We had manufacturing PMIs that came in today, yet another set of contractionary results. And then you have not just Isabel Schnabel talking about something that sounds a lot like stagflation. We also got the accounts yesterday of the ECB meeting where they talked about stagflation there too. This is not just a hypothetical being put forward by traders anymore. This is monetary policy setters talking about the risks of stagflation too. We had that traded to a large extent yesterday. The euro weakened by the most in about a month. It weakened about 0.7% versus the dollar. You also saw yields drop dramatically across the German curve, but of course mostly on the front end. But now it is Friday. It is the first of a month when we're going to get American jobs data. So we've taken a breather on that price action. The euro, it is slightly stronger versus the dollar, not back at 109 yet, but we are stronger by about 0.1%. We're also selling German bonds today across the curve. Those yields are higher by about a basis point. The other thread, Simone, that is giving us a boost in Europe, especially for metals listed on the London Metals Exchange, is what's happening out of China. We continue to get this drip feed of different regulation trying to stimulate growth. We've gotten more and more of it around the mortgage market, a double R, a reserve ratio requirement cut too. All of that lifting copper about 1 1/3%, Simone.
Yeah, Danny, while there may be more question marks out of Europe, there's certainly a lot of focus on this jobs data, question marks about what will happen there. So is it enthusiasm that we're seeing in the S&P futures this morning? Is it enthusiasm about China? Is it enthusiasm because everyone here has a long weekend for Labor Day coming up? Unclear, but we are positive after we ended the month of August with the S&P down about 1.8%. We're looking at 2-year yields falling very, very slightly, maintaining that level below 4.9%. We're now at 4.86%. And the U.S. dollar is sinking just a hair. We heard from Kit Jukes earlier this week. He was talking about how SocGen potentially could see the dollar rallying if we get a strong data number, even though the consensus is the Fed's likely on pause for the September meeting. And of course, watching Brent crude 87.52. This after Russia saying it would extend its production cuts that it's promised as part of OPEC Plus, and also we have to keep in mind that folks are heading out on the road here in the United States, but they are now, according to AAA, going to pay a seasonal record, or very close to a seasonal record, at the pump, despite the fact that crude prices have come off a bit over the last year.
It's concerning. It's concerning for this inflation picture, Simone, because we know how closely tied consumers' idea of inflation is to the pump. Could we see, when we finally have the data coming in, a re-acceleration of inflation driven by energy prices? All right, so we've had a lot of data to sift through this week, right? You and I have discussed it to a large extent, and so is Bloomberg opinion columnist Mohamed El-Arian. He says, though, that markets are overly data dependent. He spoke earlier with Francine Lacqua at the Cernobbio conference in Lake Como, Italy, about the economic challenges facing central bankers.
So you have to start at the highest level, which is we are in a different global economy. We are in an economy facing insufficient supply as opposed to insufficient demand, which is what we had in the last decade. The minute you start with that, then rates are going to be higher for longer. Then you have all the commitments that were made when rates were very low that have to be refinanced, whether it is commercial real estate, whether it is the indebtedness of certain companies that have to be rolled over. And then if you keep on going, you end up with 3 very different risks. For the US, it's about financial fragility in the non-banks. For Europe, it's about stagflation. And for China, it's about deflation. And it's a very different, fragmented outlook than what we've had before.
I love that last comment, Simone, because it's this idea that during COVID, we had synchronization of global banks. We had easing policy to deal with that. As we've started and gotten further along the tightening cycle, which was also synchronized, things have changed. It's a story to end this year in the second half of global desynchronization.
Well, to an extent, I mean, we're synchronized in a way, right? The U.S. consumer is pulling back. We've gotten a lot of signs of that in the last couple of days. In Europe, there are signs that the European consumer, European manufacturing, pulling back as well. And in China, we've had this story for a long time that the Chinese recovery, whether it's the Chinese traveler or Chinese business, just isn't coming back as quickly as anyone anticipated. I mean, to Mohamed's point, there is this minimal amount of demand, and that's really the concern. We've just switched paradigms in the past couple of years.
When we talk about what exactly the recovery looks like, what exactly a recession looks like, this is the stat that stood out to me, Simone. Among households who use SNAP, so this is, of course, the food program for those at or below the poverty line, 42% skipped meals in August, 55% ate less because they couldn't afford food. That's more than double of last year's share. Look, for a lot of America, the recession is already here. And especially heading into an election year, at some point you gotta wonder, do everyday Americans realize that what happens in the Eccles building is perhaps more important than what happens in the White House? At what point does the Fed also need to pause, because a lot of the economic damage has already been done?
Yeah, I mean, who cares about the numbers in that regard, right? And we've seen this play out over the course of the earnings season, seen strong results from the likes of the higher-end consumer-oriented names, the Lululemons in the world. But at the same time, you know, you go to Dollar General, we saw shares there sink, I believe, like 13% yesterday, in part because the low-income consumer is just incredibly weak. So we can talk as long as we want about the jobs market holding up, even if we get a below consensus estimate, you know, 150 versus 170, that still means a pretty strong jobs market. But people just not feeling that, right? The demand not there on the lower income side.
Yeah, and I know you track the retailers really well. How much do you know about the shrinking story, Simone? I'd seen in a lot of these reports, right, that a lot of the earnings that look poor was due to theft.
Yeah, I mean, it's come out in, of course, Dollar General, also come out in Dick's Sporting Goods, just some weird names. And, you know, the question there, maybe less about the consumer to an extent, but also about how much of this are just companies not planning appropriately in order to manage some of these challenges.
I don't know. I've been to Walgreens in New York. Literally, deodorant is locked up.
It's
so,
insane,
you know,
yeah.
They're doing something. Now, when it comes to jobs, again, Simone, just to remind everyone, 8:30 a.m. Eastern is the time that's going to hit. As for expectations, non-farm payrolls probably rose 170,000 in August, down from July's 187,000. The unemployment rate, though, that might stay at 3.5%. Let's get to our guest. Joining us now is Klaus Bauder, Global Chief Economist at SocGen. Klaus, thank you so much for running over. Thanks for joining us. Do you expect the data to confirm a trend of softer labor market in the U.S.?
Well, yes, sure, I do. But you know, anything over 150,000 really has to be classified as a very strong number because it substantially exceeds the natural growth rate of the U.S. labor force. And so, you know, clearly the labor market is softening. I mean, you have basically full employment, don't you? 3.5% unemployment rate, and still, even though the tightness of the labor market, for instance, in terms of the ratio of vacancies to unemployed, is definitely coming back. You're still looking at a situation where for every unemployed person in the United States, you have 1.5 vacancies.
Is it fair to say that there's been a structural shift in this labor market when you look at things like the participation of female workers come down, boomer retirements, the gig economy? I mean, it seems like a lot has changed. To what degree is that reflected in data that remains stubbornly stronger?
Oh, it's hard to say. You know, the labor market, of course, always changes. As the economy, the structure of the economy changes, the labor market undergoes these changes. Certainly, baby boomer retirement is a big factor. And, you know, that's not only a big factor in the U.S., it's a big factor in the Euro area as well. As far as female labor participation rate is concerned, from what I understand, that's actually going up again.
Oh, is it?
Yes, that's what I understand, although don't necessarily quote me. I say on television.
I was going to say, you're literally live now, Klaus.
I know. But, I mean, the thing that puzzles me the most is this very subdued trend that's not only true in the United States of labor productivity, although the latest U.S. numbers are looking somewhat better. But that's what I think is so puzzling. And that's why you have this incredibly tight labor market, whereas most economies are not fully back to the pre-COVID trend of GDP. And that is really a puzzle. I call it kind of the labor market conundrum, for lack of a better term.
Yeah, Klaus, okay, let's consider the hypothetical here. We get a very strong number, maybe 200,000 new jobs added. The question mark for the Fed at this point seems to not be really about September, according to Wall Street. It seems to be about November. How important is the data that we're going to get today to changing the narrative on what we get, not necessarily this month, but November? Does it override perhaps the softening in terms of those consumer price index data?
Yes, absolutely. You know, the Fed, of course, has a dual mandate, full employment and price stability. But that also means that they have a big focus on the labor market. And you know, the Fed has done a lot, as many other central banks. Although, you know, you can debate whether, after all this tightening, whether monetary and financial conditions truly are tight. And if they are tight, you know, how tight are they? So I think that this number is very, very important because the Fed has to see that its monetary policy tightening is having an impact on the labor market. You know, of course, they don't just look at that, but the period of sharply declining headline inflation is slowly coming to an end because oil prices, the contribution of oil price, turning positive again. And I mean, yesterday's consumer spending numbers were extraordinarily strong. So I think the economy is proving and continues to prove to be very, very resilient. And even if the Fed makes a pause, you know, pause doesn't necessarily have to be a prelude to an easing cycle. You know, it doesn't have to be, as Hugh Pill yesterday said, Table Mountain. It could be double peak as well, or twin peak.
Right. Well, let me take you back to your side of the pond and talk about the tough decision that's facing the European Central Bank. Morgan Stanley out saying they don't see the ECB hiking any further from here, and yet those inflation data, I mean, you look at Eurozone inflation that came in at 5.7% last month. I mean, do you think that, where do you think the decision's going from there? Because that one's frankly coming up sooner than the Fed's.
Well, you know, we still have, our base case is that they raise for another 25 base point, get to 4%. You know, does it make a huge difference whether we go to 3.75 or 4%? I'm not sure. You know, yes, headline inflation is declining very rapidly, but you know, I've been pointing out for some time that what the decline in headline inflation does, because it's driven by energy and by food prices rather than by, you know, domestically generated, for instance, labor cost pressures, what that means is that it washes purchasing power back into the pockets of households. And that actually increases the underlying demand pressures on core inflation. And if you look at core inflation in Europe, it hasn't hardly declined at all. Headline inflation is plummeting, core inflation is basically moving sideways. And that tells you, you know, eventually, if the headline inflation goes well below the core rate, but it is, of course, going to converge back to it. And so I think as far as the inflation picture is concerned, by no means are we out of the woods. I think it's going to be, yes, inflation's going to decline, but get to the central bank's inflation targets of 2%, I think that's still an absolutely Herculean task.
Herculean task. Is it so Herculean that not only are they going to struggle to get back to 2%, but it'll be in a stagflationary environment that they'll be doing so?
Well, you know, stagflation is a term that I really have an issue with.
Okay, what term should I be using?
Because, you know, yes, you're right. We're going to have weak growth, certainly in Europe. And, you know, how can you have strong growth at this level of capacity utilization that we have and resource utilization? So we're going to have low growth, and we're going to have pretty elevated inflation. So you could call it stagflation, but to me, you know, what really was the key to stagflation in the 70s and the 80s was that you had high inflation and weak growth and evidence of a really big output gap because you had high inflation rate, high unemployment rates. And that's the key to the stagflation scenario, is that you can close the output gap. But we don't have an output gap. I mean, if anything in Europe, the demand is running well ahead of supply. We might have in Europe an output gap by actual above potential of perhaps as large as 4%. And so this term stagflation, I think, is severely overused.
Yeah.
And I think we need to be a little bit careful with you know, what terminology we use.
I love that, Klaus, but it is much quicker just to say stagflation.
I know.
You're going to have to give me, I'm going to need to think about this. We'll brainstorm for something smarter. Klaus, thank you so much for joining. Really, always appreciate your time. Klaus Potter of Société Générale. Now, coming up, we're going to get more on the war in Ukraine with an exclusive interview with Mark Gittenstein, U.S. Ambassador to the EU. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
On security, what is happening in Ukraine is a challenge to democracy, not just there, not just in the EU, NATO countries, but really to the world. And what a tribute to democracy that the courage of the Ukrainian people.
Former U.S. House Speaker Nancy Pelosi speaking with Bloomberg's Francine Lacqua yesterday about the war in Ukraine. Now, this week has seen fierce fighting with the heaviest air assault on Kyiv since the spring. Ukraine has retaliated with drone strikes on Russia. This happens as pressure is mounting over the ongoing counteroffensive, which allies fear is progressing slowly. Let's get to our Europe correspondent, Maria Tadeo, who is joined by the U.S. ambassador to the EU. Maria.
Yes, and I am joined by Mark Gittenstein, who is the U.S. ambassador to the European Union. Sir, thank you for being with us today on Bloomberg. And I want to get a quick word from you on the words that we got yesterday from the Ukrainian foreign minister, Mr. Kuleba, who you know well. He seemed frustrated. He said critics of Ukraine should, quote, just shut it. What we're doing is not easy. But do you worry about the counteroffensive yourself?
Well, first of all, Maria, thanks for having me back. I really enjoyed our last interview. Look, I'm not a military expert. I did, just to give you a little context here, I just returned from 2 days visiting the D-Day beaches in Normandy. And the facts that were brought home to me were that it's very difficult to dislodge, especially a dictatorship which has full military power, on the Atlantic Wall 75 years ago in Normandy. It was a close call. And if, Bloomberg had covered every minute of that, or it was done on Twitter, you would have thrown your hands up in despair. But these things are very hard to do. I watched where the troops came up in Omaha Beach and how difficult it was to break through those machine gun nests. That's what the Ukrainians are doing. And they are as qualified as our military was 75 years ago in Normandy, and they have the courage and the incentive and the determination to win, and they will.
And you say with the Ukrainians themselves, they say we're fighting almost for every inch. It's not an easy operation. But then, of course, there's another question now, which is the future of Ukraine and the reconstruction of Ukraine. I want to ask you specifically about the reconstruction. This is a very active debate. You're on Bloomberg TV, massive investor community watching this. Is there an investment case in a country that's at war?
Well, this is why I wanted to come back. You and I discussed this after the last interview because it should be of particular interest to your audience who are potential investors in Ukraine. And of course there is. Look, the reconstruction process is not just about public money. It's about private money. And we're going to try and do, after this war is over and after the Ukrainians prevail, we're going to rebuild this country, okay? It'll be the biggest such endeavor since the Marshall Plan 75 years ago. And remember, the Marshall Plan was about building institutional structures that create an investment environment. And that's what's happening now through the reconstruction process, through this new platform that's been created by the G7 and the EU. and that is building anti-corruption regimes, transparency regimes, strengthening equity markets, building a regulatory regime that attracts private capital. Because that is the only way to build a democracy in a free market. And that's what happened 75 years ago in Germany, and it's going to happen again here. And the final point is, that's what Ukrainians are fighting and dying for, is a free market.
And I want to ask you about the details of that framework, because that is important for investors. But I also want to ask you about a delicate question. You mentioned yourself corruption. A lot of people are nervous about the track record of this country when it comes to corruption. Do you have faith that they're taking this seriously?
Absolutely. They have to take it seriously for all sorts of reasons. All of the substantial amounts of public funds are conditioned upon making those reforms. Accession to the EU is conditioned on making those reforms. And most importantly, Ukrainian citizens, brothers and sisters, are fighting and dying for that now. That's what they will insist upon in their political environment. And I think that's why it will succeed in the end. And, you know, it's not going to be done immediately, but it's going to happen.
And Ambassador, I have to tell you, I've been to a lot of reconstruction conferences, many. I was in the UK, I went to Lugano, Switzerland, I was in Paris. A lot of the investors that I talked to, what they say is, yes, there is a good intention behind it, but we don't have the practical tools. We're talking about wartime insurance. They worry about the technicalities of that. They also worry about some of just the everyday operations. What else can be done to reassure this investment community that's watching this, that they have the practical tools they need on a daily basis?
The most important set of tools they need. I've been in these boardrooms when they're making an investment decision, and this, in my case, in Romania. You know, I was served as an ambassador there and on a couple of private boards there. What they need is, you need to convince the managers, the money managers, that it's a safe place to invest. And the most important thing for a safe place to invest is transparency, is a regulatory process that's open. It's an anti-corruption regime that actually works. It's a court system that's independent. These things are all going to be built in Ukraine like they were built in Germany and in Western Europe after World War II.
And, sir, I also have to ask you, of course, there's a U.S. election happening next year. I know the last time we were here, you said to me you were confident that President Biden would win it. But all of the tools in the reconstruction and this help to Ukraine and this narrative around Ukraine obviously depends on the U.S. maintaining that foreign policy approach. When you hear what some of the candidates say on the Republican front, do you worry about it?
No, because Joe Biden's going to be the next president of the United States. I don't really worry about that. And the other thing that makes it is reassuring is that there's a tremendous amount of consensus between the EU and the United States and all the institutional players and stakeholders on both sides of the Atlantic, no matter who is president of the United States, on the need to protect democracy and to protect free markets. And that will continue for the rest of our lives.
So if you're a money manager, if you're an asset manager, your message is the U.S. election will not change this?
I don't think it
You shouldn't bet your money depending on the outcome of the election?
First of all, that's a year away is an eternity, so I wouldn't bet my money on that. I would pay particular attention, if I were an investor, on the conditions that are being set by the various lending institutions, by the European Union, and get involved. People on this call, on this program, should engage with our embassy in Kyiv, with AmCham in Kyiv, and find out how they can there are private sector committees and experts advising these platforms. They should be involved with that.
You say get in touch with the embassy in Ukraine. Well, your message is very clear out of this interview. Ambassador, thank you very much. It's always great to see you on Bloomberg TV.
Well,
Appreciate
thanks for having me.
Thanks. And of course, that was Mark Gittenstein, who is the U.S. ambassador to the European Union. Look, his message was clear. Get in touch with our embassy in Ukraine.
Yeah, absolutely. Maria, thank you so much for bringing us that interview. Hey, Simone, it was really great to spend the past week with you. Just 2.5 hours to go until NFP is the average 170, the high estimate 300,000.
That's right. We'll be paying close attention to that on the next program, which is Bloomberg Surveillance. But that's it for the early edition as we leave you from New York, from London. This is Bloomberg.
with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
If you look at the economic data, it just keeps coming in, showing a tight labor market. We keep getting these numbers, strong spending.
In essence, we're seeing the economy is genuinely slowing some, but it's not falling off the cliff.
I think the equity market is focused on earnings.
We are in this sort of lull, waiting for the labor market to catch cold so that we can actually, yes, stop this acceleration in wages.
At the end of the day, the question going forward is, can the consumer continue to live beyond means?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is a jobs day in America. Much going on. You think we're slipping into a holiday weekend? No. Most interesting, at least until 8:31 in the morning. Jonathan Farrow off today. Lisa Abramowitz off today. Paul Sweeney off today. I just begged for someone to come in. We are thrilled that the host of The Real Yield has decided to join us at gunpoint, Katie Greifeld, here on a Friday before Labor Day.
I was waiting by the phone. I was so pleased to get this call, and it's jobs day. Like you said, this is a pretty good summer Friday.
It's a big jobs day into the inflation report that we have coming up in September before the Fed meeting. And what's so important here is maybe we should not say jobs day, but say it's wage growth or lack thereof day. We really need to see what the wage dynamic is today.
Absolutely. You think jobs feed into wages, feed into prices, and obviously that's what the Fed is going to be focused on. And they're expecting some pretty good news today if you look at the economist forecast for that wage growth. So we'll see if that actually delivers.
Thunderscrap, our team started working in middle August to get guests to drag themselves into our offices today. And we've got a great lineup coming up. Really, really looking forward to some intense conversations here, framing up September, framing up into the end of the year, and of course, even the ECB meeting on September 14th. I'm going to get right to it because the guests right now, too important as well. Sarah House joins us always with Wells Fargo, their great labor effort. Ellen Zentner will join us, somewhat optimistic at Morgan Stanley. Great to talk to Seth Carpenter yesterday, I believe it was, from the Booth School in Chicago, the former Federal Reserve governor. Randall Krosner scheduled to be with us on bond gyrations here. And I'll start the data check with Jeff Rosenberg of BlackRock with the real yield 1.87 comes back from the disinflation tendency we've seen in the last 24 hours. Green on the screen, why not? What is it, 14 days up in a row? We'll give you some equity perspective here through the show. The end of August, now the beginning of September. The bears humbled and in retreat. Futures up 11, Dow futures up 105. That bull market VIX 13.49. Well, Greifeld's here. I've got to quote Bitcoin. Usually we don't do this. Farrah and I haven't quoted Bitcoin since Nixon was president. 26,000 on Bitcoin coming back. We'll talk to Katie about that throughout all of this morning as well. 2-year yield, 4.86%. It's a churn to the bonds, maybe a little bit higher yield. And the whole tendency across equities, bonds, currencies, commodities is to give way from a disinflation, sort of middling range bound, as I'll call it, into 2 hours and 30 minutes away, that jobs report. Of note, oil, I really want to point this out. It's grinding higher, but maybe it's just got a lift to it. 87.76 on Brent crude. I'm sorry, a 90 print there would be game-changing, and it's every day up 0.5%, every day up 1%. Even West Texas Intermediate, the American price, $84 a barrel. Katie, John Farrell looks at Euro 108.47, sort of as a dynamic here of what's going on in Europe versus what's going on here.
It's interesting at this point to see Europe and the U.S. facing really different problems here. I mean, you think about those two central banks, they've really been moving in lockstep over the past 3 years or so, but now it feels like we're getting to the point in the cycle where we could see some divergence potentially as soon as this month, since it is September 1st.
Before we get to Steve Whiting, China, it has really been something today, and in the last 24 hours, there I was looking at some point at the news, and another tweak by China, this having to do with currency reserves. What you need to know is there's not one big announcement from China, but lots of little drips. 1, 2, 3, 4 is a move to boost the currency, to give the renminbi some protection. They got it with their announcement, 7.28 into 7.26 yuan, but certainly into this American holiday weekend, all eyes on the economic challenges of China. As I've mentioned, we're really humbled by the quality of the guests this morning. You'd think everybody would be out at their 8,000 square feet in the Hamptons. Steve Whiting is not. He joins us now, Chief Investment Strategist, Chief Economist, Citi Global Wealth, truly expert on linking in the job economy, the greater GDP numbers into the profits of America. Is America flat on their back? It seems to be the great miscall of the year, and that America was really going to do poorly, recession and all that. I know you don't believe in Atlanta GDP, but we've got a buoyant economy, right?
Well, the economy will grow a little bit more this year than it did last year in real terms. But if you're thinking about employment, you know, if you go to the July employment report, the last one, 187,000 jobs. The one that we had, the July of 2022, was just below 600,000 jobs. So the fact is, input and output in the economy are growing at different pace, and they're going in different directions. We're likely to firm up a lot of cyclical businesses. You know, over the course of next year into 2025, I think employment is going to continue to slow. The Fed's going to get its way with the labor market. They are very set on having a higher unemployment rate. We just lost 2.6 million job openings over the last 12 months. Hey, we've been able to continue to grow overall employment. I don't think any collapse is coming. Right. But again, the business output and profits, which were down 6% in the year through 2Q, I think we can firm all of that up with steady headcount, and that's where we're headed.
I look at this, Steve Whiting, and what I want to do is sum in, and I rarely say this, but on this jobs day, I want to know what the Fed will look at 8:30. Within the reams of data, the two studies, what will matter for Jerome Powell and the Fed?
You know, it's rarely a single indicator. But the fact is, if labor demand continues to grow faster than labor supply, then they're unhappy, and vice versa. You know, at this point, when they take a look at an unemployment rate in the mid-3s, they want to see that the balance of labor demand it's the direction of travel. I mean, I think many will take a look and say, well, the economy can't produce 190,000 jobs every month. We don't have a working age population that will do that. But the fact that we've come down the slowing pace this much, and if it continues to move in this direction, they're going to be less concerned about whether or not monetary policy is tightened enough. In fact, I think it will head in the other direction in the coming year.
Well, Stephen, when does a slowdown in the pace of headline job growth translate into a higher unemployment rate that the Fed wants to see? You mentioned that, of course, we've seen job openings really cool down from some of the big JOLTS numbers that we were getting. But when do we actually see what the Fed wants to achieve in that unemployment rate?
It's very difficult to know whether people on the sidelines will continue to search for jobs, whether labor force participation, very active labor force participation, will show up in the unemployment rate or not. I think that the balance is probably going to push the unemployment rate up at least modestly, and it'll be at a lot slower pace of headline employment gains. And the reality is you will not see wage pressures that look anything like where we've just been. And let's just remember that, the CPI was 9%. It's now 3.2%. That happened with a steady unemployment rate.
Right.
And so very little of this to begin with had anything to do with the labor market.
Bring the board up. For those of you on the radio, our team has really put together a nice show today with some nice numbers. And Katie, the Steve Whiting math there is important. Hourly earnings growth 4.4%, and Mr. Whiting's working with a 3% statistic. So you've got real wage growth out there. Neil Dutta, the optimist at Renaissance, is saying, look, the fact is when you look at the dynamics, real wage growth is rising in America because of that disinflation.
And you could argue that you saw that in the personal spending numbers that we got this week. Consumers are still spending. And let's meditate on wage growth a little bit, because it is expected to cool again slightly this month, both on the annualized basis and the month over month. But what pace of wage growth is consistent with a 2% inflation target?
Well, this is a lovely question, because we have in the past never had wage growth at 2% to get 2% inflation. I mean, in the way the last couple of decades have worked out is goods price restraint, import prices, productivity growth in the goods sector produced a mild pace of deflation or steady prices, and services were higher. Then we started to hear during this really hawkish phase from Chairman Powell that, well, let's get wages consistent with 2% inflation. And many people thought, well, we have to do something about services prices to make sure that services prices grow no faster than 2%. Now we look at a China that has a 7.5% pace of export price decline in their currency. And we're saying, well, we might end up with a world in which we end up with a bit higher level of domestic services prices, and it's still consistent with 2% inflation, just like we've been in.
I want to go to chapter 23 of any economics book, Steve Whiting, where you are just the best, and that's the profit generation of American corporations wrapped around a nominal GDP that I believe is coming down.
Right.
A real GDP that's sort of a mystery. I mean, it can be this or that or the other thing. But is there just a belief within your work that profits will sustain and revenue growth will sustain?
I think it's going to be slow, but more positive than it's been. There are pieces of the economy. This is a lot like the opposite of that movie title. There's no collapse in everything all at once.
Yeah.
We have cycles everywhere, and we have pieces that are coming down and others that are...
Like retail's getting hammered right now.
Yeah, I think we are seeing something pretty good coming out of this. Like you mentioned before, with real wages going up, we are in the services sector where we had a depression a few years ago with COVID. We're going to continue to grow employment some. It's going to slow in its pace. But during this process, we've been able to start to pull down inventories in the United States without having a full-blown collapse. And that is working off the troubles of the industry. Now, it's not going to go away quickly. It's not going to be super fast in this way. But by 2025, we're going to have a world economy, I think, that you're going to see cyclical industries start to pull up trade, pull up production, all of these things that are restrained right now. We've had 10 months without a net gain in industrial production in the U.S. We have the same sorts of declines in exports that China's experiencing, but as an economy, it matters less to us.
I want to talk a little bit more about corporate profits. There's a really interesting piece in Barron's this week. They looked at virtually every sector in the S&P 500, and they found that net interest expense as a percentage of net profit, it's lower today than it was 20 years ago, which kind of blew my mind. When you look at corporate America right now, how sensitive is the stock market and corporate profits to interest rates?
So asset prices can still be sensitive to the competition of higher yields. I mean, we have to take a look every day at the relative value of bonds and stocks. That's one thing. In terms of, again, profitability and solvency, high-yield companies, their outstanding debt stock was financed at 6%. And again, we're talking about sub-investment grade companies. We're talking, I think the numbers for 2024 is only 8% of high yield firms will have maturing bonds. Essentially, the stock of maturing bonds is really small in 2024 of companies that would have to refinance at much higher rates.
20 seconds. Where's the 10-year yield a year from now? Are you looking for, Ian Lingen was in from BMO Capital Markets with a stunning price up, yield down for sovereign debt. Do you agree?
I think that's right. I think that we will be sub 3.5% on 10-year yields a year from now.
Stephen Whiting, thank you so much. We start strong on Jobs Day with Mr. Whiting of Citi Global Wealth. Futures up 13, Dow futures up a big 111. Make that 0.3%. We're quoting the Dow a lot today just for Pharaoh.
Okay.
He's on sabbatical. The VIX 13.48. Part of the drill here, folks, is to get one Catherine Greifeld, the star of The Real Yield, to come on. We had to talk BitDog. And the good news is there's actually a lot to talk about. How good a Labor Day is Mr. Gensler having?
You know, I think he's had a pretty tough week overall. He had a pretty crushing blow when it came to that appeals court. So hopefully he has a good Jobs Day because, again, it's been a rough week.
It's been a rough week for the head of the SEC, but then has it been a win for packaged product Wall Street? Are they there yet where they can say they've got to win with an ability to package Bitcoin, or do they not?
They can still slow walk this, the SEC. It's still going to be a process. We had some...
How long a time frame? What's the Greifeld timeline on this?
Well, the SEC has 45 days to appeal, so at least 45 days.
Okay. Catherine Greifeld at gunpoint. We do Bitcoin on Jobs Day. I'm enthused. Futures up 13, as I said before. What am I looking at? Let's look at the real yield for Katie Greifeld. The real yield here, 10-year yield, 1.87%. Steve Whiting never believed we'd get to a 187, maybe on our way to 2%. Stay with us on Jobs Day. This is Bloomberg.
This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I say to the Republicans all the time, take back your party. The Republican Party is a great party. You've done great things for our country. You're not a cult to a thug. Hopefully, as soon as we get through this, shall we say, cancerous situation that we're in, the malignancy of Trump, they will emerge in a strong way with the leadership that I know is there.
By way of Baltimore, the Congresswoman of California, no longer the Speaker, and my 2 cents is she talks differently than when she was Speaker. It's a different Nancy Pelosi than what we've seen for the last number of years. The former Speaker of the House of Representatives, they're in conversation with Bloomberg. Katie Greifeld in for like 4 people today. She's like killing it with a multiple set here. The star of The Real Yield is in on Jobs Day. as we get ready for this important set of data at 8:30 and all that's going on. And, you know, is going to be a sleepwalk August? No. Sell in May and go away? No. Sleepwalk through August? No. We didn't do that in here on September 1st. We welcome you on equities, bonds, currencies, commodities to all that we do here at Surveillance. Florida, Georgia, the Carolinas, they pick up the pieces of a hurricane in America. There is a hurricane to the east of Bermuda called Franklin, but far more active and always more active on the far side of the world are typhoons, and it is tangible in the evening in Hong Kong. This is from Kowloon. This is a shot. Our executive producer Qantas has a suite thing going on at the Peninsula Hotel. This is a shot outside his hotel room. Over at Hong Kong Island, the Bloomberg headquarters is there as well, the convention center, and of course all of the memories that we have of Hong Kong, and of course the new Hong Kong, so Beijing influence. What they're influenced by this morning is the second highest typhoon alert. They are back 5 years in terms of gravity. The exchanges are shut down, and we'll be following that through the weekend here at Bloomberg Worldwide, and particularly with Yvonne Mann and all of our Hong Kong offices as well. We speak to the typhoon of political strategy. Gregory Vallier joins us right now, Chief U.S. Policy Strategist at AGF. Greg, I loved your elegiac note about August. Write the note for September right now. Where are we going to be October 1st?
Well, I'd say, Tom, good morning. I'd say there's going to be three big issues as this month proceeds, this new month of September. The first is the very real prospect we could have a government shutdown on October 1 because we can't get even a continuing resolution. Number two, I think there'll be still a tremendous amount of speculation on how Ukraine did in the month of September. They're finally making an offensive. Things look a little bit better now than they have for the last few weeks. And then the other big story, I would argue, Tom, is the United Auto Workers, whose contract expires on the 14th of September. I think it's entirely possible on October 1, we'll be looking at a strike.
Well, let's start with the last on your list there, given that that's the most urgent in terms of timelines. What would you expect to happen between now and then? Would you expect that we can avert this strike, or does it starting to feel inevitable?
Well, you know, we averted a strike with the Teamsters and the UPS, so it's possible it could be averted, but in the last 24 hours, there's been a lot of nasty talk. The union is saying the companies are not bargaining in good faith. So this will go right down to the wire. Even if there's a deal, Katie, the other big story here is how enormous the salary increases are going to be.
And of course, that's a timely point, given that we are awaiting those jobs figures at 8:30 a.m. today. And obviously, wage growth is going to be one of the things we look for first. When you think about the political aspect of the strikes, and really they go across industries, and it's been striking, if you will, to watch that this summer. How does the Biden administration handle this? Obviously, Joe Biden is seen as pro-union. How does he turn this into a talking point, a campaign point?
It's a difficult task for him, Katie. I think that you'll see more sour rhetoric back and forth. The union is not happy with Biden. Biden realizes that there's a lot on the line here. And I do think even a brief strike is going to put the president in a very difficult position.
Hey, Greg, look at where we're heading here. We had a Republican debate. I assume we've got others on a Vallier date calendar as well. And as we heard earlier, I mean, from Speaker Pelosi, the Democrat from Baltimore, her father was mayor of Baltimore years ago. She's begging for a return of the Republican Party to a normalcy of another time. Is that wishful thinking on the part of the gentle lady of San Francisco?
Yeah, I think, you know, her father, Mayor D'Alessandro, wouldn't recognize either party right now. And I'd have to say that one of the amazing stories of this really remarkable summer is that with all of the indictments of Trump, all of the really serious charges, he's held up brilliantly in the Republican Party. He still leads in most every crucial state by at least 30 points. In some states, his lead is close to 40 points.
I look, Greg, at where we are, framing it up forward and all that. I just have to wonder what the response can be to the absolute original position we're in with former President Trump. How does Tim Scott respond? How does Washington respond? How do the big Republican donors respond to the predicament President Trump is in?
Well, that's a really good question, Tom. I think that increasingly the donors and the establishment in the Republican Party are looking at Glenn Youngkin, the governor of Virginia, fairly moderate, very wealthy, good campaigner, won a crucial victory in Virginia against Terry McAuliffe a couple of years ago. So I think that there still is room for one more candidate. But as of right now, it's going to be an uphill fight for any late entrant to really make a dent in this huge lead for Trump. Tom, there's a chance that Trump could be the nominee under indictment. There's a chance that Trump could be in jail and still could be president. It is not totally out of the question.
Greg Valliere, thank you so much with AGF Investments. And I want to draw to your attention as you look for your reading into the autumn, the absolute world-class character of Bloomberg Opinion on legal issues in America. It's so advantaged to have Noah Feldman of Harvard University with us, and the leadership of Tim O'Brien, expert on the Trump finances way before the politics, going back decades and decades and decades. Look to Bloomberg Opinion to sort out so many of these contentious issues as we go through 2024. A little bit of time here, some technical difficulties there with Greg Valliere, which gives us the advantage of talking to the star of the real yield. Ian Lingen of BMO stunned me yesterday by framing out a 10-year real yield from about 1.50%, dare I say up to 2.2% as well. And I asked him, does the economy fall flat on its back with 2.2%? What have you learned in your discussion of this on the real yield?
I believe he called it a screaming buy, right? The 10-year
10-year price up, yield down.
Heard around the world, at least from where I sit. That was fascinating. And even though you have seen the price action agree with Ian Lingen, it still feels like people are bracing. The investors that I talk to are bracing for higher yields from here. There's a lot of talk that maybe the fair value rate for the 10-year Treasury right now is closer to 4.5%. We got pretty close to that this month.
Yeah, but aren't these just opinions? Aren't these just like, I mean, I get it. We listen to all these people and that, and you're suggesting the consensus is for higher yields right now.
That's what, at least the consensus that I speak to.
Well, that's the, you're doing afternoon TV and a morning TV, they're all looking for lower yields. So
You've got the optimist. Is that optimistic at this point?
That's a really ambiguous question and an ambiguous outcome as well. And the basic idea here is it can cut either way. If you go price up, yield down, Ed Hyman is looking for disinflation over at Evercore ISI. And if you get price up, yield down, is that good or bad for the economy?
Well, it seems like Ian Lingen struck the optimistic tone that it's, a case to be made that the Fed has inflation under control. But you're also speaking to Cameron Dawson. I really prepared for this show, Tom. I loved what she said, that if the 10-year yield is going back to 3%, that's a screaming sell for equities. That's a recession.
Yeah. Would somebody get a memo to Greifeld? We don't prepare for the show. We just sort of show up and break open the tang and move forward. It is Jobs Day, and seriously, it's going to be something special treat. The only one of a team not taking off the day, Michael McKee, will be here to pick up the pieces with Sarah House, senior economist, Wells Fargo. Michael McKee at 8:30. Good morning. It's Jobs Day.
what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis.
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Browns and John Farrow off today. Catherine Greifeld has joined us here. Are you filming The Real Yield this afternoon?
I am, 1 p.m.
There we
Eastern.
go.
It's a big week.
It's a big week, and for your Labor Day consumption here, The Real Yield, you can look for that out on our digital project, also on Bloomberg TV, because the real yield really matters, and especially matters to the Federal Reserve meeting that we'll see here the third week of September as well. Again, a great lineup today. Ellen Zentner, Randy Krosner will be with us as well. Really looking forward to that. But right now, let's dive into under surveillance. We've got 3 under surveillances today, and the first one we're going to sit on, as they say, and we're going to do this with USDCNY. This is the Chinese renminbi, the yuan, and I asked Meredith to take it back longer to the historic moment where I met John Farrow. Ooh. I met John Farrow in the upper left corner, 2005-ish, when it was fixed and they gave way to an ever-strong Chinese boom and a strong renminbi, and we have started to give it back with a vengeance. We're at the 7.26 this morning, and there's a lot of talk about moving higher, a weaker Chinese yuan. And Katie, nobody I know is framing getting back to 2005 in the fixed level, but never say never. I mean, there's a lot of turmoil there.
There is. And I remember I actually started out covering currencies, and I was fascinated with the yuan.
Oh, is that Bitcoin's a currency? You're going to sell me on that right now?
Yeah.
Gary Gensler's watching this morning, so step
Bitcoin in like 2017 didn't talk about it as much as we do now, but 7 was seen as a line in the sand.
Well said.
Yeah, and we've blown past that, obviously. We initially got above that in 2019, right when I left the beat. I had been waiting for it, and then we got past it. You look at the levels we're at today. I wish I could tell myself 5 years ago that we'd be here.
Yeah, a headline just out moments ago. In Shanghai, they eased the home buying mortgage rules. That's got to be one of those tweaks we mentioned, the water drip here of 5, 6, 7 things going on in Shanghai. Francine Lacroix will drive forward the conversation for us, her Italian coverage at Chernobyl today. Greifeld out looking at new Teslas this weekend. Tesla unveiling a revamp of its Model 3. It's bright red.
Yeah.
Just hours after the EV maker, they rolled out price cuts on S, on X, on there. What's the so what here? I was surprised in our reporting they haven't done this for 6 years with this entry model.
Exactly. And then there's some great quotes in this piece that if you're running with a 6-year-old model compared to the steep competition that you have in China, you're behind. So they finally unveiled it. And to the point, Tom, that you made about bright red, 2 new colors. Stealth gray and ultra red is what they're calling it.
Yeah, you know, people know. I mean, you all know I'm a Tesla skeptic. I mean, I've tried to get Mr. Musk on the program. From the peak of 2021, we go to the Bloomberg terminal while we do under surveillance. And from the peak of 2021, Test Dog is down, is it 27%? 37% from the peak. And yet it's deemed a success right now. I mean, it's really had a good year, good summer.
It has had a good, I mean, Tesla, it's synonymous with volatility, right? So to see this kind of chart, maybe on a different stock would be a little bit concerning, but they're having a good year despite it being a very tough year. They've really tried to boost sales. They're just murdering margins to do that. And whether or not it's working, it's up for debate.
Yeah, we'll have to see. Alec Webb thank you to Alec Webb in London for giving us some really EV perspective here. Certainly a topic into this new September. Jobs Day, there are, I can't even count them, with ISM coming. Farrell cares about ISM. ISM out at 10 o'clock as well this morning. A plethora of data. And I'm sorry, I'm looking at the wage dynamic because I think that's what the Fed's looking at.
Yeah, it sounds like it. And just this week, obviously, all of the focus is on NFP at 8:30.
NFP.
But
that's non-farm payrolls,
non-farm payrolls. But we've had an embarrassment of riches when it comes to jobs data this week. We had JOLTS, initial jobless claims, going to get NFP as well. You weigh it all together.
Right.
And it seems like the message so far is that this labor market is loosening, but I think it's the wages picture.
On radio, stay with that screen, Amy, if you would. Wells Fargo, 160,000 on down to JP Morgan. Gloomy Ferroli, 125,000. And what's important here, folks, is you're popping that monthly number of, let's take a center tendency, of 150,000 off of an employed base of over 150 million. And that's how you get the variance, is that we're looking at little teensweens numbers across, frankly, both surveys against a ginormous American labor force of 150 million. This is tough to do. I got it right once. I quit guessing after that.
Yeah. I mean, to your point that we're looking at a huge base of employed Americans,
Right.
I think one of the details that's going to be important to pick out is how employed are they? When you look at the average work week, the hours worked has been going down. We know that firms have been hoarding labor. They don't want to cut back on workers. And as a result, you have people working fewer hours.
Mr. Bostic of Atlanta, speaking in Cape Town, South Africa, some important headlines shaking out about to happen on debt in the United States, and maybe that speaks to commercial real estate as well. Staying on this jobs report that we'll see in 2 hours, Sarah House joins us now, senior economist at Wells Fargo. Sarah, I was doing the math there on 150 million, which is, as you well know, that 1 over the square root of n. Okay, there's enough math for Labor Day. How predictable are these numbers this morning? Do you have a feeling you got your handle on 8:30 this morning, or is it just a complete mystery given the jumble of the American economy?
Right, so payrolls are notoriously difficult to predict. You know, the BLS says they only have a 90% confidence interval that whatever number they print is going to be plus or minus 130,000 from that number. But I think we do see, you know, we do feel pretty confident that that trend is slowing. So I think we're seeing that from a range of labor market data. So not only the openings data that we saw this morning, but I think also consumers' own view that there aren't so many jobs out there with that labor differential coming down. We're seeing it in those purchasing manager indices, so not just the ISMs, but the regional Fed ones showing that the pace of hiring has slowed. But, you know, to your point, getting that non-farm payrolls number, you know, within 10 or 20,000 of consensus, that's usually a win in my book.
And Sarah, what is the potential impact from these numbers on this soft landing debate that we're continuing to have here?
Yeah, so I think really the labor market holds the key to whether you can pull off that soft landing. So continuing to see businesses add jobs, that's helping in terms of consumers' income and therefore their own spending, while giving time for some of those supply side issues from the pandemic to unwind. And I think the labor supply story is very much a part of that. So we have seen a pretty nice run of gains, or at least steady rates of labor force participation, which given the demographic backdrop is effectively up. So I think that's helping keeping those hiring numbers pretty strong. But I think we have seen them step down, and I think a question is, you know, to what extent do we see that pace continue? Does it level off at a more sustainable pace, or given the fact that we still have tight monetary policy, that those catch-up effects from the pandemic in terms of hiring are fading? Do we essentially barrel past that sweet spot for job growth and keep that recession risk elevated?
And Sarah, you take a look at the expectation for the unemployment rate, expected to hold steady at 3.5%. In a conversation we were having with Steve Whiting just a little bit ago, at what point does the slowing that we're seeing on the headline number, the pace of job growth, actually translate into a higher unemployment rate?
Right, so it's very much dependent on what also happens with participation. So if we think about just kind of the run rate to keep the unemployment rate unchanged, if you're also seeing the participation rate unchanged, it's probably only 100,000. So I think, if we are getting somewhere around consensus, so around 170, we're at 160, I think that's still consistent with the unemployment rate, roughly flat. If you're also seeing that strong labor market pulling workers in and supporting that participation rate.
Sarah House, I have the memory of a 10% unemployment rate and Wells Fargo doing industry-beating research based on John Sylvia looking across deciles, each 10% of the American employed public. How confusing is almost a cross-sectional decile analysis now? Is it smooth and easy to analyze the deciles of America, or is it just a jumble?
Well, you can get a sense of what's happening among different groups of workers. So really where we continue to see some of the strongest job growth as well as pay increases, it is in what have traditionally been those lower paying jobs. And so while we're continuing to add a great number of jobs relative to the gains in the population and the overall labor supply, I would say that the quality of those job gains are deteriorating as you are seeing them shift more towards lower paying sectors, and those workers aren't seeing the same staggering wage increases. So that does portend to slower growth in labor income as we move through this year, which could constrain consumer spending.
What does the hollowing out of the middle class look like right now?
Well, I think you're seeing, you've seen in terms of some of those middle wage jobs, we're still seeing slower growth amongst those, and so I think you still see that pressure. But the flip side of that too is you're also seeing, I think we talked about the lower wage jobs, but you're also still seeing decently strong growth in some of the higher wage jobs. So it's really dependent upon which way some of those more mid-skill workers can break. Do they have the time horizon to perhaps retrain to some of those higher paid jobs, or are they essentially forced to shift down and into those lower paying, lower skill jobs?
And Sarah, I'd love to bring the summer of strikes into this conversation. Of course, we're approaching a deadline for those UAW talks. When you think about some of the massive pay increases that we've seen, aside from being idiosyncratic, when does that start to show up in the data, if it does? What does that mean for wage growth from here?
Yeah, I think it means that it's going to be still very difficult to get wage growth to slow to a pace that the Fed is comfortable with on a sustained basis. So, we're seeing the employment cost index shift lower. So in the last quarter, that was up at just over a 4% annualized rate. So it's off the peaks of closer to 5%. We're seeing the same thing in average hourly earnings, at least slowing on trend. But we're still seeing compensation growth running at a pace that just is not consistent with the Fed's 2% goal, even when you factor in some of the productivity numbers, which have looked pretty decent of late. And so I think that speaks to the fact that even as we're seeing the labor market easing and beginning to loosen, that we're not necessarily close yet to a point where we can say that it's no longer exerting upward pressure on inflation, and we can really call that this recession scare has been avoided.
Sarah House, thank you so much. We'll call you back at 8:30 if you single the non-farm payrolls number. Sarah House at Wells Fargo there before this jobs day. I want to take some time here, Katie Greifeld, on oil. West Texas Intermediate 84 rounded up. Wow, up $1, up $85. I'm going to round it up to Brent crude rounded up to $88, maybe 87. To be fair, Brent crude basically across the summer 74 to 87. I think this has been underreported.
Underreported. It is pretty amazing to watch that. It feels like we stopped worrying about energy prices in terms of inflation when you think about just the headline number that we're getting on CPI. a lot of that downdraft that we've seen, you can thank oil prices and energy prices for that. Now that we're seeing this climb, back-to-back gains on crude oil, Brent oil, it's going to be interesting what this means for some of those headline figures and what this means for the Fed.
Gallon of gas peaking out at $5 a gallon. Down we go almost to $3 a gallon, a plunge there. John Tucker got the Hummer out, the H2 out. He loved it this summer. And then we climbed back. But I don't think we've climbed back like Brent crude. $3.82 a gallon here, up from about $3 before. I mean, it's a lift. It's demonstrable. I don't know if it matters for President Biden, but I'm sorry. I've got, with all of our guests talking here, including Jeff Curry over Goldman Sachs, I got 87.88. I wasn't there on Monday of this week.
No. And you wonder what the ceiling is, what we're going to see in terms of supply. Still a supply-driven market.
No, my answer, folks, is look to the emerging markets. Look for the demand that we see on the Pacific Rim. Jay Pulaski of Morgan Stanley with us yesterday, enthused about what we could see in oil demand. His colleague, Ellen Zettner, it's 7:30. Join us this Jobs Day.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The problem with China is a growth problem and a debt problem. And the growth problem needs a revamped growth model, not just tinkering with what you have, but fundamentally changing what you have. And the debt issues need fundamental restructuring. Otherwise, pockets of indebtedness will become systemic.
George Clooney from the shores of Lake Como there with Bloomberg Opinion. Oh, there's a gray hair that fooled me. Mohamed El-Arian, as good looking as George Clooney there with Francine Lacqua at Chernobyl. It's really wonderful. I went once. It was like 40 degrees. There was sleet on the water, but it's really spectacular. It's an important meeting where people really think about the state of Europe among everything, and there's certainly a lot to think about there. John Farrell really helping us with the ECB and what we're going to see to September 14th. But front and center right now is China and the mess that it is. On this Jobs Day, we're going to digress here for a bit and talk to someone with real Beijing cred. Everybody, you go to Hong Kong, you hang out at the Mandarin, and you think you're a China expert. Or maybe you go up to Shanghai, the Peace Hotel, you look down the Bund and go, I'm a China expert. Or then maybe you actually live it. Katie Greifeld with me here. Everybody else is off today. Tom McKenzie is not off because he has lived China.